Hello everyone and welcome to Simply Learn. I am Pratik Shinde and I will be your learner success manager for today's session. It's great to have you all here and I hope you are having a wonderful day so far. Before we jump into the exciting content, can you please confirm in the chat if you can hear me loud and clear? You can type yes in the chat box. Okay, awesome. Thank you for the confirmation. After the session, we will send out a short survey. Your feedback is priceless to us. So please take a moment to rate the session and tell us how we did. Please add comments to the survey, which will encourage us to keep doing good work or improve. Closed captioning is available for the session. You will have to enable it to follow the conversation closely. The same will be made available in the session recording also. So before we dive in, let's do a quick audio check with our trainer. Hi Ranjita ma'am, can you hear me loud and clear?
Yes, Pratik, you are loud and clear. And just confirm if my voice is also loud and clear.
Yes ma'am, we can hear you. And now I will make you the presenter so you can begin with the session. All right everyone, happy learning.
Hi, team. Very good afternoon. Good morning. Good evening. So, we are on our eighth day of this PMP cohort program journey, and we are just on our planning project topic. And we had begin yesterday with our schedule that we have finished, and then we started with our resource planning. And in that resource planning, audio issue. Okay, please, can I have a quick confirmation for few learners if it is for many or only for one-on-one, only Mukund is having? Okay, it's clear, no? Voice is clear or any disturbance? Fine, thank you so much. So we just started with our resource planning. So we know that in our adaptive project, we don't have as such to plan for resources because we are working with a kind of a self-organized team and people are just collaboratively working together to develop the project objective. In the case of predictive, it is the project manager who has to start with the resource management plan where he has to have a proper strategies, all those tools and templates should be there, that how the responsibilities would be shared, what type of resources would be required, how we are going to acquire them if it is not available within the organization. So that is what we had to ensure, that right resources should be available to project manager for the carrying out of project activities. So we just do two activities in our planning, that is a resource management plan, and we have to identify the resources for our activities. This is what is the task in our predictive. So we discussed yesterday that sometimes we have to look beyond our internal team, where we look for something that we have to outsource, or some material, some goods, or some services. So we discussed with our procurement management plan. So in our procurement, we always have to first define a plan, that is the procurement management plan, and that plan will guide us all the procurement related activities, what to procure, how to procure, what type of procurement documents we would be using, just like your RFQ, RFI, or if you're going for your bids. So that is what is the those documents we have to have, and then what type of contracts would be used based on the project to project. So we covered yesterday fixed price contract, where we know that prices are going to be set upfront in the beginning only, and it is always preferred when we have a well defined scope, so that the buyer will always have a least risk in those fixed price contract, but it is only going to be preferred we have once we have a well defined scope. And in case where we don't have the well defined scope, and we know that we have to do some kind of an R&D, some kind of an uncertainties are there, then we do prefer our cost reimbursable contract. So in the fixed price also we talked about firm fixed price, we talked about fixed price incentive fee, we talked about the economic price adjustment. It is going to be used once we are looking for long term contract and we want to consider the risk related to the inflation, so that the seller will have a kind of a control on the risk for those inflations part. And then we moved on to our cost reimbursable contract. So this is what like we talked about cost plus fixed fee, because this is where we prefer once we have some uncertain scope R&D we have to do. Cost plus incentive fee would at least some kind of a control buyer can have, because he can just encourage the cost saving or at least time saving for his project. Then we talked about the award fee. Here we want to focus more on the quality, or maybe we want to have some kind of a judgment based on the working. Now the third type of contract is what we prefer, that is a hybrid contract, that is also known as time and means. So time and material contract is a kind of a contract where we are having the features from both fixed price also and cost reimbursable also. This is what is the T and M. So we use this type of a contract mostly even in our software project, even in the agile project, because our scope isn't defined fully upfront. So we know that we have our scope which is evolving, and we just want to have a flexibility so that we can just adapt to our working or the changing requirements. As we are going to progress in our project, we know that we want to remain flexible so that we can adapt our work as we are moving towards. So in this type of a contract, we just have a buyer who is going to agree to pay the seller or the vendor based on the resources he is going to provide. So all the resources will be paid on their actual hours, actual working. So that is what is a fixed we have based on their actual working. Plus, buyer will also bill us for all the other equipment, supplies, material, whatever is going to be consumed during the project. So this is what is buyer is going to just provide what type of resources are required, what kind of their qualification should be. So based on that, the vendor supplier is going to provide you the staff. That is what we use mostly in the staff org. When we want to acquire some expertise, we want to have some staff augmentation. This is where we would be using, and we know that our scope is going to be evolving. Mostly when you are doing some consulting project or your software development project, so what happens in this type of a contract, so you would be having some kind of a flexibility. No, people will be there, but sometimes we do have a kind of our hardware cost, isn't it? Software licenses cost, Krishna. That is what we are talking about, that the other expenses, that is what you can say time and means, material or like that. So it is just as good as when we say we know that we want to sign up a contract where we are working on some project. Maybe we have a kind of a some working for different banks, so you have signed a contract with the vendor or with the buyer, with the seller, sorry. So that seller or vendor, I'm just coming to that vendor is, we have that, we have asked him to provide one senior developer and we need a junior developer also. So might be you have discussed that, okay, the senior developer would be paid on, let's say, $50 per hour. Junior developer would be paid on, let's say, $40 per hour. So that is what we had discussed. And material cost would be in the form of our software cost, licenses are there, hardware cost, other things. So that is what we would be having for our this banking project. Now the vendor is not concerned about whether his developer is working for which bank project. So it is up to the buyer, like what type of assignment you are going to give, because we are going to pay them on the actual working hours. So in this, mostly, like if you see, we do have in some of the organizations where we have to submit our timesheets, isn't it? So how do we make sure that how much time we have utilized for these resources? That type of monitoring is required from the buyer's end. So you have to have a provision, you have to have all those kind of your procedures, so that you will be keeping track of their actual working. So might be the senior developer has worked for, let's say, 100 hours, and junior developer has worked for, let's say, 150 hours. So senior developer would be paid at the rate of $50, at the rate of $40. This is how we would be paying. So that is what is the total payment would be paid to the vendor, and whatever is your, let's say, license cost, hardware cost was near about our 10K dollar. That is how the total payment buyer is going to make for this. In this type of a contract, just to ensure, we do have sometimes where we have a kind of a capping, not to exceed limit, just to be having a kind of a risk managed. So buyer will always have that this contract where we do add a not to exceed limit. So that says the vendor cannot bill for more than that. That is how we are trying to uh, like keep a kind of a control on that. Yeah, it is per day also. It is not that per hour always, it could be per day also. So mainly we are paying to the vendor as per their actuals working. So whenever your vendor is providing you that consultant or that particular staff, so whatever rate he is negotiating, maybe it is $1,000 per day, so that includes his profit margin also. That is what on the actuals you would be paying. You just hired a digital marketeer, or you just hired a graphic expert for your project on contractual basis. So that is where we have signed a contract with the vendor that we need a graphics expert. So he would be getting paid maybe $1,000 per hour or $500 per hour, whatever is we have negotiated. So now it is up to the buyer that what kind of a graphics designing you would be asking him to do. So here we just want to have that flexibility in the scope, isn't it? So now we know that our scope might be changing. So if that person 10 day he has worked, so he would be paid on 10 days. If that work has been done completed in 7 days, we can have that 7 days payment. So you are going to pay the vendor on the actuals, what their actuals working they have done. That is where we would be paying them, plus the cost reimbursable part, that is what all the other expenses in term of material, equipment, what is getting incurred in the project, that also you are going to bear. So that is what we say, it is the combination of fixed price plus cost reimbursable. So you are going to pay the vendor for those staff which he is providing on their actual hours fixed, and then the reimbursable for all the incurred cost related to the software, hardware, or any other material also. That is what is the time and material contract. You may have some flexibility where you can have some more permutation combination. No, it is per day amount is not basically salaries, means it is basically you have hired a expertise through some uh, other company. No, that is what they are the vendor, isn't it? You are the buyer who needs a AI expert, let's say. So you have hired this AI expert from the seller, vendor. So he has provided you that AI expert at the rate of $1,000 per day. That is what we have negotiated. So if you know that according to your project, you are going to use this expert for 10 days, you would be paying him at the rate of 1000 for 10 days. If it is 15 days, because your scope is evolving. So based on the working, yes, Lynn, here the risk would be shared for both. That is what we say it is a hybrid contract. In this type of a contract, it is always risk would be shared between both, isn't it? But here we always have a kind of provision, no, that we have a flexibility here. We can even have the different versions for this also, where we can put a not to exceed clause also with this time and material, that this is the maximum that the vendor can bill to the buyer. That is what is a not to exceed limit that we can have, where we have no precise scope. We know that we have something to develop and our scope is going to change. So that is where we cannot prefer to go for cost reimbursable contract, but rather than time and material contract would be a better option. That is what even in your some of the project, if you are going for the consulting, because consultations part also, that is where you would be using this time and material contract. Or even some of the time in the construction projects also, we prefer this time and material, especially when you are renovation, you're doing the renovation project, old building renovation. See, but you do have a kind of a in this particular contract, no, based on the timing, isn't it? The buyer and seller is going to share the risk, because the seller doesn't have a kind of an assurity that how long it would be required, isn't it? So based on the working, based on the scope what we have, we would be using the seller's resources, isn't it? Because buyer is going to pay the seller based on their actual working. So that includes their cost and profit. So we know that when we have the kind of a working, so based on that availability, based on that billing hours only, he would be getting paid for. Because sometimes as a buyer, you may terminate the contract if you are not satisfied with the seller's resources or their working. So seller may lose their expected future income also, no, because he must have thought that maybe for 30 days, 40 days, but we do have a provision where we can have our early termination also. Or sometimes you will face a kind of a issue when the buyer is negotiating to you, where you have to even cut down your profit margin also, isn't it? Because both of the sellers and buyers will be sharing that risk. That is what is we do prefer this type of a contract with the evolving scope. So both it is going to be there. So we may have our early termination clause, isn't it? That is what in the agile you do have your master service agreement. That is what we have signed with the bank. Now they do issue some small work orders based on that for their working part. That is what like we do have a another working with this IT projects. This is how we mostly prefer time and material there. And even in some of the agile project, we do follow our fixed price increment contract, isn't it? We know that we have signed a contract where the buyer is just going to pay, let's say, 25K dollar for 2 weeks of sprint. So if our project is going to finish in 6 sprint, that is what 25K into 6 would be the payment. And we do have in this software industries agile project, there is another version, we call it as a graduated time and materials. What does that mean? Here maybe we just signed a contract, so based on the efficiency we are having the rates. So if higher the efficiency, higher the rates. If you are going to delay their work, rates also would be reduced. Just like if you complete on time, we will be paying you, let's say, $100 per hour. If it is delayed, it would be, let's say, $80 per hour. If suppose you have finished ahead before, we would be paying you $110 per hour also. So that is what this type of a provision helps us in timely delivery of the work, as well as the seller would be more accountable for doing that work on time, isn't it? Only for delayed hours? No, no, this is basically we would be negotiating with that for the complete, not for the delayed, for the complete one. That is what we have a graduated for every, like it is for everything. If you complete it, so total would be done it in that way. This is how we do have a kind of a negotiations that happens when we are signing these contract, right? So if we just want to understand in nutshell, so we do have these type of a contract. So I just mentioned firm fixed price contract, where you would be preferring once we have a well defined scope, isn't it? So that is what is the kind of a preferred type. And when we know that we don't have a this well defined scope, and firm fixed price incentive fee would be used where, when we know that we want to get our work faster. So that is where we know that for the seller incentive matters. He would be doing it timely or before time. Economic price adjustment is basically when we have a long term contract and we want to consider the inflation risk also. That is where we would be preferring our fixed price economic price adjustment. Cost plus fixed fee, when we are doing some research project or we know that scope is something which is uncertain. Cost plus incentive fee, where we would use it because we want to encourage cost saving from the seller's part. He should able to do the work in a lesser cost, so that it would be always having some kind of a risk control for the buyer's end. Award fee, where we are more focusing on the quality part, isn't it? Quality, or we want to judge the work. Based on that, we would be sharing this type of a contract. Time and material is again unclear requirements or evolving requirements. That is where we always go for time and material contract. So when we sign up a contract, we know that contract should include all these information for our future working, isn't it? We do include sometimes the penalties, waivers, all those conditions as well, so that it is going to be helping us in monitoring our contract. If it is delayed, do the vendor's rate are affected for the next time? That is what, if we have chosen that kind of a contract type, no, graduated time and material, so definitely we can always negotiate. This is what you have to see, what type of a discussions, what type of a negotiations we have done with the contract. So if you have signed a time and material contract with your graduated part, graduated clause, in that case you can consider, isn't it? Graduated time and material contract, this is what even in our agile project they do prefer. So based on the efficiency of the seller, we can always negotiate it for our next working with that contractor. So these are the all terms and conditions that should be there, the components of a contract that we do keep, responsibilities of both the parties, deliveries date, authorities, your technical business aspects, pricing and payment terms, provision for the terminations, all your applicable guarantees, warranties, your waiver conditions, your penalties, intellectual property, confidentiality and the data privacy, if it is that kind of a work, and you know that all those things you have to ensure that they are not using the real data. If it is a kind of some regulated industry project, so they need to use all the dummy data for all their project work. All those things goes into our contract components. Let's do the question. So time is up already. I'm just sharing the poll result. So 77% people have opted for option C. There are few people who have opted for A as well. Let's see the justification, then I would be discussing. So Mukund, there is a Mukund question there, that what if in IT only vendor resources have caused delay? Mukund, so in that case, definitely you have to see, no, because we can always, if it is a kind of a time and material contract, you would be asking the vendor to provide a replacement of that resource, or that is how sometimes we even uh, cancel the contract also, terminate the contract also, if it is a kind of very critical issues, isn't it? So that is what it is always there. So if the because you would be asking for your vendor only to pay for those reworking, isn't it? That is what we need to have, all those kinds of our control on the vendor's resources. So this is the question. I think a few people answered this cost plus fixed fee. Why could would not be cost plus fixed fee? Because if you see the question says project budget is limited, isn't it? And we do have a well-defined requirements and a stable scope. Budget is also limited. Don't you feel cost plus fixed fee would be causing a more risk on the buyer? So why you want to take that risk? Because already we have a limited funds. Won't you feel firm fixed price is always the best option for a buyer? If the scope is fixed, it would be always less riskier for the buyer. So this is how, that is what we have to always prefer, with a well defined scope, so that buyer would be always at the least risk. That is where we make use of this fixed price contract. Now let's do the second question. This is a bit tricky question, no? So already I'm ending up the poll. So what is, there is a tie between option, not tie but closely, A and C, isn't it? We do have few B's also in our chat window. So when we have to plan for our procurement strategies, procurement management plan, so we know that what we have, we do have to use all these things, isn't it? That is what you know. So we would be using all of these things when we are preparing for our procurement strategies. So what is the first step? Whether procurement statement of work would be done first, or the procurement management plan would be prepared first. Anybody who would like to give his thought on this? What should be done first, especially the people who are from this procurement? A, C, B, D. All right. Nitish, statement of work should be first. Somebody says RFP should be first. See, always when we say, it might be a kind of a case, but again, I'm just this question intentionally I added because might be as we go as per the PM book, PIM book, it says plan is what like we have to have, because there we have our all these documents. No, in the procurement management plan we do define our all the procurement documents. So that is what like it says we have, because they think these all goes parallelly actually, because when we are defining our procurement management plan, so we do define what has to be done, what could be your strategies, and also the type of contracts, it will go into that only. So that was a very tricky question, because somebody will say first we have to define our procurement statement of work, then we go for the procurement management plan. Even people have answered that also, statement of work and your procurement management plan, because procurement management plan will include everything. What are our procurement documents, what are our strategies, what would be your vendor selection criterias, what would be the type of contracts we would be using. So this is procurement, this the statement of work is a part of your procurement planning only. No, that is what I'm saying. When we are developing our SOW, so it is a part of our procurement planning only. So it is just like if you consider preparation of your SOW and other document that goes with our planning. So we will be finalizing our plan along with that. So all of these terms comes with our planning aspect only. All right, it is just for the understanding part I have just added. This is not a kind of a question that you may expect actually, because it is just we have to understand all these things are with the part of our procurement plan only. We will have all our procurement documents in the procurement management plan. So that is how you would be doing it almost parallelly. Fine. So this is what like we have used. So this was a topic we covered, our plan and manage procurement and the planning of resources, especially in the predictive. That is what like we know only one task we do, that is the planning for our procurement, what to procure, how to procure, the type of contracts and the procurement documentations. Now, moving on to the next interesting topic, budget planning. Now, here we are not talking about the costing accounting, but here we are just looking at our project budget. How we are going to plan for our project budget, especially in our predictive and our adaptive both. So, we do have three processes here in the predictive. First is your developing a cost management plan, which will give us all the strategies, all the tools, all our templates that would be used for monitoring our project budget and for sharing those performance reports for our project budget. All that thing will be going into cost management plan. Then we have to estimate our cost. Estimating cost means you have to estimate the cost of each activity or the work package. Determining budget is where we are looking for the project budget. That is what is the three activities we will be doing it in the case of predictive, and also we'll discuss how do we have our estimation for the adaptive project also. So as we know, in the predictive project we do start with the fixed budget only at the beginning of our project. So always in the predictive, you have to do the upfront planning. And though we know that we can make the changes in our budget as we would be progressing. So hybrid is again, we have a tailored approach. So based on the situation, we would be just adapting to that. And in the agile, we do have a concept of a burn rate. We'll talk about this burn rate also. But ideally, what do you understand by this burn rate? What is this burn rate? Especially the people from the agile project, they must be. using them. Burn rate is not doing multiple tasks. No, it is one of the very important metric we use to calculate at what rate our project is spending the budget. Yeah, it is basically at what rate we are burning our resources, burning our funds. So this is how we calculate. If suppose we have spent 50K dollar in our 4 weeks of sprint, and we know that we have a total 4 sprints where we have planned that we would be completing in 180K dollar. So now we know that we just have 130K dollar remaining for our 3 sprints. We'll just discuss that. How do we do that burn rate? So burn rate is nothing but what we have spent over time. The budget you have spent over a particular time period. This is how we calculate our burn rate for the project. The rate at which project consumes its financial resources representing the negative cash flow. Burn rates are often used by the agile projects to budget their cost for the planned sprint or the increment. So in the case of our agile project, the team would be collaborating with the stakeholders, partners and finance stakeholders to suggest the incremental budgeting approach. That is how again we use a very lightweight estimation we'll talk about. We do plan for our sprints for estimation that. Now starting with our predictive budget planning. So as we know, first step is you have to create a cost management plan. Now tell me whether this cost management plan you would be able to see your project budget. Will it give us the budget of the project? Yes or no? No. Purushottam says yes. No, no, no. You will not see your budget in the cost management plan. You will not find your schedule in your schedule management plan. You will not find your scope in your scope management plan. These plans are the guide me document. They just outline the strategies, tools, formats, your thresholds, how you would be managing and monitoring and controlling your that aspect of the project. Costing, this is what it would be telling us. So again, as we know that we have to first define our plan, which will be telling us all those strategies, what should be our thresholds we have to maintain, what would be our performance reporting for our project budget, and then we need to employ our estimation techniques to assign the cost for activities. So in our predictive, already we talked about various estimation techniques. Remember, analogous, parametric, 3 point, and bottom up. So all those techniques are very well applicable for cost estimation also. Then we would be having our cost baseline. This is what we would be using. Now, instead of going through this theory, let's do an exercise to understand this. So, already we know we have our project, website project, and a construction project, right? So, we have already defined our activities. So, you have your activities, we have estimated the duration also, and we also know the resources who would be working on these activities. So once we have done it, so based on the resource cost, whatever resources you are using on the activities, whatever hardware, software, equipment and the workers, based on that we have got our estimation done. Just imagine you have your activity where, let's say, this resource is working and this is this estimated cost. So total duration of this activity is 40 hours. So that estimated cost for this activity would be $3,200. Similarly, this one, that is what we estimate. This is what all the activities are there. So we have estimated the cost for all these activities. Similarly, in our construction project, we know that for all these activities you would be using some equipment, some labors, and there would be some other expenses also, isn't it? All your overhead cost, whatever it is there. So based on that, we estimate the cost of our each activity. That is what we do in our bottom up estimation. So once we have estimated the cost of our activity, now after this each cost, you can also add your overhead cost. So this has become your rolled up cost for your entire project, isn't it? So our project cost is, estimated cost is 32,860. Now tell me, this is what you have done the estimated cost for your project. Will you be sharing this cost to your management, or you want to add some reserve over this cost, then you share it to your management? How you people plan it? Do you just share the estimated cost which has come, that one, or you do add some, apply some contingency? Yeah, that is what now we would be doing here. Now contingency reserve, how do you calculate? How do you assign? You assign on the percentage, 15%. Yes, 15%, 10% percentage, because that is what most of the time is our preferred way to add this contingency reserve. But we will understand that how we can make it more accurate. Yes, I'll just coming to that only, Mithun. Contingency, usually in the beginning, we just have some percentage that depends on the project to project. What is the risk associated with that project? Based on that, we do have to do. If you feel that you assign 15%, 20%, 10% as a contingency, that is what, let's say, you have assigned your contingency for this project also. So maybe we have assigned, let's say, 25,000 as a contingency reserve. We will discuss, because this contingency, which is 25,000, is just on some thumb rule. It's a ballpark figure, we can say. But in uh, most of the, like, if you want to have a more accurate estimate for this contingency reserve, so we need to use that data. That is what we will be discussing in our risk planning. So once we have done the risk planning also, and we have got that particular data with us, we would be having a more accurate contingency for our project. So there are two types of reserve that we use. Contingency reserve is basically the reserve that we always apply for our known risk. We also call it as known unknown. Known unknowns means the risk that we have predicted, the risk that is a part of our risk register. So, based for addressing those risks, for their risk response strategies, we do use this reserve amount. So, once we have added our contingency reserve over this estimated cost, that becomes your cost baseline. So, your estimated cost plus your contingency reserve is our cost baseline that we would be monitoring throughout the project. Cost baseline is what is in the hand of the project manager. You have to manage your project within this cost baseline only. But above this cost baseline, there is another reserve which is always with the management. We call it as a management reserve. So what happens? We know that there are sometimes few uncertainties related to the regulations, related to some other unforeseen circumstances. So that management reserve is always at the discretion of the senior management. Your board, your senior management will decide. Okay, so that is where that depends on organization to organization. What is the management reserve? Let's say our management reserve is $30,000. So your cost baseline plus management reserve is the total project budget. But as a project manager, you would be managing within your cost baseline. That is what you have to add in your overheads, right? You have, when you are estimating your cost, you have to consider everything, your all the cost related to quality, your cost related to your other softwares, hardwares, your services, everything we have to estimate. I'm just coming to that. So contingency reserve is basically the reserve we have kept to address our known risk. That is a part of our risk register. Management reserve means this would be utilized for unknown unknowns. It is also sometimes you may come across this term unknown unknown and known unknown. Unknown unknown means the risk which even we could not predict, something which is not a part of a risk register, not identified risk. If we face some kind of a uncertainty that you haven't predicted, that risk, that issue would be handled by the management reserve. You always have to escalate anything which has impacted our project, which was an unforeseen, maybe all your regulatory changes we cannot predict them, so all those uncertainties, earthquake, those could be predicted by your tsunami, your all these things, that we would be using management reserve. For sure, you will have a question based on this understanding, contingency reserve and management reserve. So contingency reserve is basically a reserve which is associated for the identified risk. Management reserve is basically the reserve that would be utilized for our unknown unknowns, the risk which we have not predicted. Those are what we will be escalating it to the senior management, because management reserve is not in the control of project manager. You have to always seek the approval, right? So that is how we have to do this estimation. That is how we say always the bottom up estimation would give us a more realistic figures, but again we do have a range of accuracy, we do define a range plus or minus threshold also, isn't it? That is what we do have. So we already had prepared our project schedule, no, that how these activities have been sequenced. So once we know how and when these activities are going to happen, so based on that we know how we are going to spend on your project. Yes, Mandipa, that is what you can always have. No, because if you know that this is a kind of a risk where we may have an unplanned risk, unplanned leaves, so you have already considered it. So for that, you have to have a contingency, isn't it? Because already it is a part of our risk register. This is already we know that it could happen. There is no as such guideline, Dhanshri, for the management reserve. It is totally at the discretion of our senior management, because based on your project risk, they would be keeping that management reserve with them. So now we already had a schedule with us that how and when we are doing those activities. We have estimated the cost also for those activities. So let's say we have our expenditure like that, what is how much we are spending on our week 1, week 2, week 3. So the estimated percentage is what, as I told you, few organization have 8%, 10%, 12% or 15%. That is what we keep for the management reserve. We do have a calculation for contingency, we do not have a calculation for management, because this is something unknown. So once we will be planning for our risk, then we would have a more accurate contingency reserve. We'll just discuss during our risk planning that how do we calculate our contingency. So based on the data, we are coming up with some figure. That Swati is again up to the management, right? So mostly they do disclose it, but again it is at the discretion of the management whether they are disclosing this management reserve to the project manager or not. So mostly you will find they will never disclose it, right? So it is always controlled by your senior management only, because once the funds are available, so they will keep their management reserve with them, and this is how they would be, the balance funds is what they would be allocating for the project. So the project manager always have to focus on the management reserve only, sorry, contingency reserve only. So contingency is what he would be always looking at. So what we were discussing this, that already we have our project schedule, so we know, and we have estimated our cost also for these activities. Anubhav, management reserve you would be utilizing, suppose you got a kind of a regulatory impact, or there is a kind of a risk which has impacted your project that was not a part of our risk register. Now you know that to handle that risk, there would be some funds required. So you would be escalating it to your senior management, and from there you have to get the management reserve for that. No, 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 Anubhav. Management reserve is only for the unknown unknowns, right? So now we have our estimated cost for each week, and we do have a cumulative cost also for our project. So now we know that already we have this. So how do we have our cost baseline? So cost baseline is nothing but it is the cumulative cost against your timeline. That is how we would be preparing. This is your S curve, isn't it? So this is your week wise, let's say this is our cumulative cost curve. That is what we call as an cost baseline, and this is budget at completion cost, highest level of our cost baseline. Krishna, project budget definitely would be a kind of your physical money, isn't it? How you are going to spend? I'm not getting your question. Because right now when we are planning for our project budget, project expenditure, isn't it? So what we are trying to tell right now, we are just sharing that this is what is our budget. That is what we have shared our baseline, right? So based on that, now we'll coming to next, isn't it? We I have just done our estimated that this is what we are looking for our approvals, no? So we know that at what time how much we are spending. So we need to get those funds available to us, then only we would be able to do our work accordingly. So your senior management always give you the funds at different phases. They will not allocate you the entire fund in the beginning. So they will first review your baseline, and based on that they give you the stage wise funds, isn't it? That is where you would be utilizing it. This is what we are just going to do next. We'll talk about that also. So right now what we have done is, yes, isn't Abhishek? Right now I have used it on week wise. Website project was there, no? We could have it for month wise also, isn't it? That is what, just to explain you how do we calculate our cost baseline. This cost baseline is nothing but cumulative cost over your time period. So that time period could be weeks, months, days. So it always takes the shape of S. That is why we say the cost baseline is in the form of S curve. The especially people who are using the Microsoft project Primavera. So once we have done our planning, we have developed our schedule, we have estimated the budget, so assign the resources, it will automatically give your cost baseline. The highest point of cost baseline is your budget at completion cost. This is in our case would be 57860. That is our budget at completion cost. You didn't get this S curve? Don't you find this is our timeline? This is what like we call it as an escar. Yes, Krishna, because I have just used it. So mostly cumulative cost would be because in the end we just have a kind of over handing over all those things of activities. So it is usually, it is just I have used some dummy figures in that. No, management reserve is not at all a part of the cost baseline. Cost baseline is what as a project manager you have. So cost baseline is your estimated cost of your activities plus your contingency. That is your cost baseline. Cost baseline plus management reserve is our project budget. So these are important for sure. As I told you, based on this understanding, you will get a question on your exam. When we are developing our cost baseline, because this cost baseline is what is in the control of project manager, and you would be monitoring this cost baseline only throughout the project. Like suppose as of week 3rd, what is your actual expenditure? Let's say this is our actual expenditure, this was our planned, so that is what we would be monitoring, right? This is how we have to use this cost baseline. So once we have our plans, so we have now our total cost baseline, also what is the total budgeted completion cost, we would be doing it. Divya, management reserve is basically something which is there within the management control only. Senior management will have some funds with them that it going to be utilized for unknown unknowns, because in certain case where we have kind of a uncertainties just like earthquakes or your tsunamis which may have impacted our project, or maybe a kind of a regulatory changes which has impacted some project funds, where we know that we have to manage those risk, manage those issues by spending some funds. It is going to impact our project baseline, cost baseline. So those uncertainties which were not there in our risk register, for them we do utilize the management reserve. So just keep one thing in mind: contingency reserve is used for the known risk, the risk which are a part of your risk register. We call them as the known unknowns. Management reserve is basically we use for unknown unknowns, not identified risk. That is the management reserve. So you got this complete cost planning in the predictive project. We know that we have estimated the cost for each activities based on the resources. So what is our estimated cost for each activity? And when we are estimating the cost for activity, we have to consider everything: your labor cost, material cost, infrastructure cost, IT cost, services cost, whatever it is there. So on that, we have applied our contingency reserve, and then we would have our baseline. Ankit, I'll just let you know there is a formula for contingency reserve. I'll just guide you. For the risk planning, we do it. Why we call it as an unknown unknown? Because it is something that even we are not knowing it. No, known unknown means the uncertainties which are known to us. Keep it in that way: the uncertainties which are known to us which may happen, not 100%, but there is some chances that these uncertainties will happen. We call them as a known unknowns, but there are something which even we can't predict. So that is why we say they are the unknown unknowns. Those uncertainties are even unknown to us. This is why the unknown unknown and known unknown, Nisha. So for calculating this contingency reserve, we do have a formula. This is what in risk planning we'll do. So we just calculate this contingency reserve by percentage in probability, the probability percentage, because every risk has some probability, some likelihood of its occurrence. It is not 100% because uncertainties cannot be 100% sure. So maybe we have a 50% chances of any uncertainty. Let's say there could be a 50% probability. What if we have a kind of a power shutdown, or maybe some kind of our resource misusage? We may have a kind of some misusage of the resource. Chances are, let's say, 50%. And what would be the impact of that risk in dollar? That is what is the probability multiplied by impact gives us the contingency reserve. If there is a 10% probability that because of the uh, estimation, that estimation we have done, maybe we are not able to get the output of our resources, and it may impact additional resources to complete our work, which may have $100 impact. So 10% of $100 would be in your contingency reserve. That is how we will discuss. There are few risks which we have identified, and we have to plan for those risks. And based on our planning strategies, now we know this should be our contingency. This should be our expected monetary value that we should have to deal with those risks. That is what is a part of our contingency. We'll just discuss that in our risk planning. We calculate our contingency reserve by multiplying the probability and the impact of those risks. So that gives us a more accurate estimate for our contingency for the project. Because right now 25,000 may be okay, may not be okay, we are not sure, because there is no as such calculation we have done for it. Prashant, we will talk about that contingency in the risk planning. It is the probability multiplied by the impact. Probability will be in the percentage and impact would be in your dollar. So we know that there is a chances, the 10% chances, if vendor is going to delay this particular work, we may have an impact of $10,000 on our project. So that would be your contingency reserve. There is a probability that because of this rainfall, because of unexpected weather, maybe we may face our impact of 50K dollar. So that is what we calculate our EMV, the contingency reserve. Similarly, we have our contingency reserve for the schedule. There is a 10% probability if this employees may have unplanned leaves, it may impact 5 days of delay or 2 days of a delay on the project. So we do calculate that contingency for our project. So we do have this reserve for duration as well as the cost. We'll talk about this contingency in our risk planning. Did you get this now? How we have done our estimation? Once we did the estimation for our activity, we got the added the contingency reserve. So we got our cost baseline, and we already had planned our schedule. So based on our schedule, whether it is a month wise, week wise, day wise, so cumulative cost curve is what we get as a budget at completion cost. That is what it is explained over this slide. Now, as I was telling you, because you cannot get your physical money in the beginning. So that is where we know that every organization, every project, you would get your funds phase wise, isn't it? That is what we know. What is the funding limits imposed by the senior management? So that is what we know, that we do have our funds, that we would be having our firstly that 200K on this time, then we would be having some funds, maybe 100K more. So total funds would be the 300K here, and here we have our final 500K. So this is our, this is, so that is what, like, we know what are those funding limits imposed by the senior management, and what is our expenditure on the project. So it should be aligned with our funding limits, isn't it? So when we know that these are the funding limits which are imposed by your sponsor, so we have to now regulate our expenditure, our cash outflow, so that we can protect ourselves from any kind of overspending. That process is what we call as a funding limit reconciliation. So we just compare our planned expenditure of our project funds against the limits which are imposed by the senior management. So we need to align our planned funds, planned expenditure, planned spending against our available funds. Because if you feel that we have planned our expenditure and we know that our total fund will get exhausted here, so then we have to just stop our work also for this time, no, because funds are not there. You cannot just go and ask your management for the early funds, so that is not a good practice also. So now we can always reschedule certain things. If you have planned for some equipment purchase or something, some other activities which you can reschedule for next phase once the funds are available, that is what, as a project manager, now you have to look into your final schedule. That is where now we can adjust the things before getting the approval for our baselines. That is what is this process of funding limit reconciliation. Align your expenditure with your limits from the sponsor or the organization. So usually, as we have seen in the schedule and the scope, we always start our cost planning also based on our historical information. Look into your previous project records. All that document will give you some idea, because right now at the early stage we always start with our rough order of magnitude, where we will be just looking into our analogous estimation, parametric estimation. That is how we can give the figure to the senior management. As we move ahead, where we have defined our scope, we have our activities, we have assigned our resources, then we can go for our bottom up estimation. That would be more accurate. So we have to match our project needs with the resource availability. This is how the predictive project we get our cost. This is how we are going to have our initial estimate also, and we can modify it as we would be moving ahead. Now, how do we estimate in the adaptive project? Assign blended rate, estimate your user stories, have your cost per point, and then estimate your budget. Now again, too much of theory. Let's do the estimation in the agile project also. So as per that sheet, how do we estimate in our agile? So that slide gives us the step by step procedure. So what we do first, assign a blended rate. Now what does this blended rate means? Blended rate is nothing but, in our agile project, we just take the average salary of our team. So we know that in our team, you may have your developers, analysts, scrum master, product owner, all those. We do have our scrum team. So we just take the average salary of them. Let's say the average salary of our scrum team is $100 per hour. That is the average salary. Okay, so this is called as the blended rate. Maybe you have your developer cost, you have your product owner, you have your scrum master, you have your designers, you have your analyst, you have all those people, maybe your testers. So that is what, if you have two developers, their salary would be somewhat you would be paying them, isn't it? So this is how we have to take their average. That is the blended rate. Now we have already done the estimation, isn't it? If you remember yesterday when we developed our product backlog, when we developed our sprint backlog, so we know that in our sprint, how many user stories we have. Let's say we have taken 3 user story. And how did we estimate it? We have used that planning poker, isn't it? Story points. This is how we have. So first user story is, let's say, 8 point. This was also 8 point, 5 point, and this was 3 point. So how many total points are there? 26 points is there in our sprint backlog. So total story point in our sprint is 26. Anuvrit, just focus first, because we always focus on a lightweight estimation. We always try to do what for one sprint, okay? Sprint wise, iteration wise, no? We will just forecasting that also. Right now, we just estimate for a particular sprint. So we are just trying to calculate our per story point cost. That is what our first focus is. So we know that our blended rate is this, and then we have our total 26 story points. Okay, that is what it is there. Now, what if suppose we have to first understand our velocity? So based on our velocity, the team has completed 20 story points. So we just calculate our cost per story point. So cost per story point would be how much? So loaded salary of entire team. So we have our team, let's say 2 developer, one, one analyst, and 1 tester. So we have total 6 team member. So total salary of 6 team members, and our sprint is for, let's say, 2 weeks. 2 weeks means how many hours? If we are assuming Monday to Friday, 5 days a week, so 10 days into 8 hours, it would be 80 hours sprint. So 6 teams working for 80 hours at the rate of $100 per hour. So the total loaded salary of our team would be 6 into 80 into 100. So $48,000 is our loaded salary for our team. Now we just calculate our total team salary right now here, okay? When we are assuming the team work, so we know the total, this is the salary for our 48,000 loaded salary, and we have velocity of 20. So what would be your cost per story point? So per story point would be your 48,000 divided by 20. So 2,400 is the total cost per story point. Now, how do we have our estimated budget for the entire project? In our product backlog, we had now 110 points. So for this 110 points multiplied by 2,400, that is there, plus your overheads in terms of our travel, in terms of our hardware, your software license cost, your other expenses, whatever it is there, that also we would be adding up. Let's say that total overheads and the other expenses for our project was 15,000. So that total forecasted budget for our project would be 279,000. That is what this slide is saying. How do we do the calculation is in that. Velocity is how many story points team has delivered in one sprint. So we first assign a blended rate. So we know that our blended rate was $100 per hour per team member. Then we estimate our points using planning poker or affinity diagram. That is what we know that, so that how many story points can be completed. That is, let's say 20 points is the team velocity. 20 is the team velocity. So we just estimate the cost per point, loaded team salaries divided by points completed. No, as such, no requirement to remember these formula. Just understand the concept. Simple thing. You know that how many story points team can deliver in their one sprint. So we know that 20 is the team velocity. For right now, just forget this part. So you know that we have our total team velocity is the 20, and the total loaded salary for our team member is 48,000 for 2 weeks of sprint. If you have some of the team member part time working, maybe maybe there would be some resource who would be shared for 2 or 3 project also. Then when you are doing that blended rate calculation, you would be considering their 50% or 25% salary for taking that average. So blended rate is the average salary of all our resources, and based on that we calculate the loaded salary of our team for that particular sprint. So that is what is 48,000. Cost per story point is nothing but loaded salary divided by the team velocity. So we get to know our per story cost, per story point cost. Now in our product backlog, we do have 110 points to be completed. So the total budget for that would be per story point multiplied by 110 point plus the other overheads. So this is what is the slide is also saying. The step by step process. Assign a blended rate. Overhead means if suppose you have procured some software, no, Anuvrat, for this project we have some other travel cost also, some other expenses also, that also you are going to add it. Other expenses in term of your hardware, software, equipment you have purchased for this project. That is what. How was the 2400? Yes, I'll do that also. How it got calculated? You know that we have our loaded salary for entire team is 48,000. So total salary divided by your velocity. How many story points we have delivered? So we have delivered 20 points. So 48,000 divided by 20 gives us 2400. So we are simple calculation. No? We have delivered 20 points. So how much it had cost us for each story point? That is what we have estimated here. Got it? Loaded salary is the loaded salary of for that period means We have 2 weeks of sprint. 2 weeks means 80 hours we are working. And there are six team member, six team member working for 80 hours at the rate of $100 per hour. That is the total loaded salary, isn't it? 48,000. $100 is the blended rate, isn't it? $100 is the blended rate. You just understand, there is a developer whose salary is, let's say, $10,000 per month. Testers, two testers are there. Their average salary is, let's say, 110,000. Scrum Master 150,000. That is how we are taking the average salary of our team. If anybody is working part time, maybe partially for the not 100%, 50% allocated for your project, you will consider their 50% salary only. So we just discussed, when in the predictive project you are estimating your cost, so we have to consider everything. Know your dead labor cost, materials, equipments, facilities, services, if you are using any of your softwares, IT services, and the contingency reserve. That is how we derive our cost baseline. So mostly, as I just mentioned, when you are in the early phase of your planning, we do use our parametric or our analogous estimation, isn't it? Based on our past experience, we completed this particular projects in 200K dollar. So that is how this time also it may be, we are expecting this much to cost. That rough order of magnitude might be this much accurate. Sonal, don't get confused. We have taken the total estimated salary, no, here we have just taken the total estimated forecasted cost. So we know that total forecasted cost is how much? 279. This is our total forecasted cost. Now we know that at the rate of 20 velocity, we would be requiring to have at least 5 sprints to complete. So 5 sprints are required, and this is our overall estimated forecasted budget. That is what we are not taking. We just know our, this is what we discussed yesterday, no? We know that we have our product backlog with 140 points. The product backlog has got total 140 story points, isn't it? We have seen, based on the features, based on the epics, we have done the t-shirt sizing, which is large, which is extra large, which is medium. So we just assign a story point for medium, large, extra large. So we know that there are total 140 points to be delivered as of now, which may change, but right now we know that 140 points. And our velocity is, let's say, 20. So how many sprints would be required? 7, isn't it? That is what we do estimate for our sprints also. How many sprints would be required based on our team velocity, which is current? Because team velocity is usually going to be more consistent after your third and fourth sprint. In the initial first, second, third, we are just trying to get adjusted. That is what we don't consider that as a velocity. After the third, fourth sprint only, we consider that. Yes, Sonal? So I was just discussing that initial stage when we are just using that parametric or our analogous, that might be 25% to plus 75% wrong. If you're estimating something $100, that $100 could be $75 to $175. That much it may range. Accuracy would have this much of range when we are using our rough order of magnitude, initially parametric and the analogous estimation. Even when we have done our bottom up estimation, that is how once we are, yes, this is based on our OPAS, based on our prior experience. This is based on our bottom up estimation. As we move ahead, we have estimated the activity cost, then the overall project. That also might be -5% to 10% wrong also. And then we know that we always prefer to have a phase wise estimation, rolling wave planning. That is how we have our detailed estimate for our project. So this is how we work in the predictive. And we know in our adaptive project, we have our evolving scope. So we just use our lightweight estimation method for high level estimation. That is what we just used it. Blended rate, that is how we are calculating it. Yes, it is a break time. So we have almost completed in our estimation part, budgeting part, and we'll take a break. We'll do the question after the break now. Phased estimation is nothing but, as we know, we always have a detailed estimate for our phase wise. Right now, we are focusing on our designing and the foundation and the structure part. The finishing part, detailed estimate, we will be doing later. Right now, we just have a high level estimate allocated for our finishing. We need to manage with that, but the detailed part, we will be doing it later. This is how we prefer, no? That you have assigned that, okay, we are going to keep 100K for our finishing work, progressive elaboration. That is what is the phased wise estimation. The detailed estimate we will be doing when we would be coming near to that particular phase. So taking a break for 10 minutes, then we will resume with our questions and the remaining topics. Krishna, right now we are focusing on our project estimation, isn't it? Project planning. So you're right now focusing on what this project is going to cost us, isn't it? That is what, like, you always need to know, no, this would actually going to be incurred in my project. This is my fund. This is what we need to always first know. That is how you can align it whether your project is going to give you profits or not. That is what we have to do in our planning. This is what you have to do, a proper estimation first. I hope everyone is back. Yes. So what we covered on this Excel sheet is same, no? We estimated the cost of each activities. We got the total work packages cost. We added the contingency reserve. That is what our cost baseline. Above this cost baseline, we add a management reserve. That becomes the project budget. So project budget is nothing but cost baseline plus our management reserve. So let's do this question. So I think unanimously I got three more B's. So everybody has answered B only because we discussed it. Only one answer we have got for our A. So this question was talking about the confusion between management reserve and contingency. We will Prashant discuss during our risk planning. All this risk planning, how do we estimate, no, what is the probability, what is the impact, all this would be the risk, because for that we'll talk about what should be our strategy for these risk. We'll talk about that. So with that we know how do we plan and budget in our predictive and the adaptive project. Moving on to the important topic, that is the risk planning, because when you would be applying for your application, no, so it would be always a good idea that you should include some of your planning activities from the risk and the quality in your application. That your project management experience should include at least one planning for risk and one from this quality part. So whatever, like based on your understanding, when we say risk, what comes or what strikes your mind? How can you say what are the project risk? Risk are the overruns. Okay, that is what is again a risk which will have a negative impact on your timeline and the over expenditure. Some things that can derail the project, anything that can negatively impact compliances will have a negative consequences, schedule impact, resource skills, unknown cost, issues that have negative impact but not happened, right? Unexpected unknown hurdles, environmental risk, organization risk, stakeholder dissatisfaction, all negative, no? Risk are always negative. Qualities fail, that will again impact on your project schedule negatively. No, will not talk about in the project management, because that is what is a kind of a something where you have to unlearn. So we know that risk are the conditions of uncertainty that might occur, and if they occur, if any uncertainties occurs in your project, it will have variety of impact on the project. It may have a positive impact also, it may have a negative impact also. Now we know that there is a risk dollar weakens. If this dollar gets weakened, don't you feel it would be have a different impact on the importers and the exporters? Do you agree with that? Yeah. So can't we say it would be having a positive impact on some and negative impact also, isn't it? So risk is an uncertain event which is going to, if it occurs, because it is not a kind of a surety, it is an uncertainty, but if it is occurring, it may have an impact on the project positively or the negatively. We may have a risk from wide range of known and unknown causes, maybe outside and inside the business environment. We talked about those pestle, TECOP, no, those are all framework we know that which may have a kind of an impact on our project. So risk development is indicated by a trigger condition. So in certain cases, we know that we may have an indication that risk is about to happen. I think last day also few people do like they have mentioned, no, we know that what if our employee leave in between. Krishna, I'll just come to that also. How can risk be an opportunity? I'll just come to that. I just mentioned, no, that dollar weakens would be a kind of an opportunity for someone, isn't it? So we'll just discuss about those opportunities also. As I told you that people were asking me that what if our key team member leave? Again, so always we know that when you are trying to discuss with your team member, or it is just a kind of a, you're observing the people working, and during that kind of a discussion or a kind of your working part, you just overheard or you just get to know that your analyst is not happy, he is having some kind of a dissatisfaction, maybe based on his salary part, or maybe because of the working culture, or maybe because of some growth opportunity he is not getting, so he is a kind of a demotivated. So now that is the trigger, that if you don't look into it right now, there is a high chances that person may leave the company. That is where like the trigger indicates you that we still have a time to take certain action. That is where as a project manager now you can see, if you know that this particular person is a critical resource for you, so now you have to see, can I do something just to motivate him, maybe if he's looking for some good learning opportunities or some career advancement, or if he feels that he's not getting a good compensation, so can you do something for that, so that you can try to mitigate it? Or at least can I have a kind of a strategy where I can start planning for a secondary resource, maybe some cross functional training that you can do for your people. That is where our strategy has to be. So when we talk about this risk planning, especially in our predictive project, as we know, we have to do the effective planning. We need to have our strategies so that we are not looking for any reactive action, but we need to have a proactive plan how we would be able to mitigate those negative impacted risk. So trigger condition is just an indication about that risk. Just like before a rain, no, we know that we will have all those cloudy weather, strong wind. That is just an indication that risk is about to occur. So you can do something for that. Now there was like, how could risk be an opportunity? Now we know that we are working on some new technology, and there is an kind of an uncertainty, maybe you have a high chances that this technology will work, isn't it? So if it works well, definitely it will have a positive impact on our timeline. We would be saving at least a weeks on our project, we would be saving few dollars on our project. That is what is a uncertainty which has impacted on the positive way. We know that there is an opportunity in our project, If we combine the orders of our laptop for 2 or 3 projects, we could have 20% saving on our orders, computers, our laptops. If we implement a proper material management system, there is a high chances we could be saving 20% on our material wastage. Don't you feel this would be a kind of an opportunity? That is what we are going to look for. There is a kind of an opportunity, that new market segment is there, which is going to have a better sales opportunities for us. So any uncertainty which may impact our project positively, that is what is an opportunity. If we complete our project early, there is an opportunity to win incentives. Threats, all of us had already given so many example right now. So whenever you find any risk which has impacted your project negatively, that will become an issue. Or maybe there are some risk, there are some uncertainties that had happened which we have not predicted, unknown unknowns, that will always create an issue that we have to act upon. That is what is the difference between risk and the issue. We'll do that also, because risk is always a future based, it is always not, it's a kind of an uncertainty. Issue always focused on the present current situation. Already we have a kind of an issue prevailing, that our project is being delayed for 2 weeks. Now that is an issue, we have to act upon that issue. So, in our predictive project, our first thing is we have to have our risk management plan, which will give us all those strategies for managing those risks. And what are those various sources, those categories from where we have to identify. Second is your risk identification process. Once we identify the risk, then we have to do the analysis. So two types of analysis we do in the risk. One is the qualitative, and then we would be going for quantitative. Then we have to have a response plan strategies, plan for risk responses, how we are going to address those risks. So these are the five processes in our predictive project that as a project manager we would be working on. So this will just give us a risk management plan, and all the output of this is nothing but the risk register would be updated. So once we identify our risk, that means we are working on the risk register. And I'm sure all of you must be having your project risk register, isn't it? Because it is a very good saying from the PMI, project manager should carry risk register always with him. You must be having your different formats, but every project manager do have a risk register, isn't it? What you people record in your risk register? What all information goes into that? Do you have your own formats with you? How do you develop all risk, and what all should go into that risk register? How you maintain that risk register? You know that these are the risk. That is a risk description you have mentioned, that these are all probable risk. Then what else? Impact, probability, mitigation plan, isn't it? Yeah, that is what we would be now looking into. So these are all project risk as per our severity level, as per our shop lifestyle center case study. So these are the project risks, because already we know in our project charter also we have our high level project risk, but that is on always at a project level. But we now have to have a detailed risk register, and we need to identify the detailed risk for our project. That is what now we would be doing it. So when we talk about our risk, as we know, risk is always having the likelihood of its impact on the project, isn't it? It could be opportunity, it could be threat. Positive impacted risk are the opportunities, negative impacted risk are the threats. Now, business risk means Whenever you are doing a project or you are going into that, so we know that there is always a risk, there is always an opportunity for both gain also, loss also. Just imagine when you are investing in your stock market. So we are investing in that stock market with the risk that there may be an opportunity for gain, or there may be where we would lose our money also, isn't it? That is what we call as a business risk. And then we have a pure risk. Pure risk means it will always have a negative impact, negative outcome, all like your accidents, natural disasters, fire, theft, all will have a negative impact only. We call them as an insurable risk also, because this is how we manage those pure risk by doing some insurance by uh, making the third party responsible. So this is what, like in the predictive project, it is not that we are just documenting our risk and we are just taking the reactive action. If the risk have a positive impact, we call it as an opportunity. If the risk have a negative impact, we call it as a threat. The risk that if developed would create a positive impact on your project objective, and risk that would have a negative impact on the project is the threat. So these are the terminologies in the project management context. So risk is basically defined as an uncertainty, event of uncertainty, which may be impacting our project either positively or negatively. Pure risk would be negative only. Business risk may have an opportunity for both. We just classify because in the predictive project also there would be some business risk and there would be pure risk also. All your weathers, no, thunderstorm, earthquakes, all that, cyclone, heavy rainfall, accidents, that is all our insurable risk. Now, adaptive project, already we know we always prefer to work in a smaller increment, because here we are trying to take the feedback and we are working with the progressive elaboration so that we have a good control on the risk. That is what in the adaptive project we are always making use of those ceremonies, no, sprint planning, daily scrum, where we are trying to look for, where we are trying to address all these uncertainties, all this risk. So we always do them in a real time because we are working with that mindset. There are risks, there are uncertainties with every user stories. So we document our user stories in the product backlog. So we do have a risk for our user stories also, and based on that we would be working on our project increments, the sprints. This is how we are taking the feedback and we are working progressively elaborative manner. Now, for the predictive and even some of the hybrid project, we have to first understand some of this risk parameter. Then only we can create a strategy. Because when we talk about our predictive planning, it is always we are not looking for just documenting the risk and making a plan for that. It involves that we have to have our strategies, that how you are going to develop those strategies for your risk, so that you would be trying to mitigate, you would be trying to minimize the negative impacted risk. That is what is the effective risk assessment. That is what you would be developing. This is what we have to define our strategies so that we can have our risk management plan. So there are some risk parameters before you are trying to define your strategy. So we have to first understand the risk appetite. What does that mean? So risk appetite is nothing but it is the amount of risk an organization is willing to take. That would be like, just as I mentioned, how many of you are investing in the stock market considering that risk factor also, where you know that if you're investing, let's say 10K dollar in your stock market, it may become 5K also, it may become 20K dollar also. Considering this risk, how many people are going to invest from our team? Or let's go in that way, how many of you will not go to invest in your stock market considering that risk? If you're investing your 10K dollar, it would become 5K also, it would become 20K also. So considering this, how many of you will not invest? All of you will invest, or there are some team member who will not go into invest in the stock market looking at this situation? That means all of you are going to invest? Yes, everyone. That means all of you are having a high risk appetite. You are a risk seeking people. Okay, that it means. But I am a kind of a risk averse. If you go with me, I will not invest in the stock market. I am not a kind of a person who invest in the stock market. So that is what I will classify myself as a risk averse. I have got low appetite for that risk. So mainly when we talk about this risk appetite, it is just the degree of uncertainty an organization or individual is willing to accept in anticipation of the reward. So you may have a high, moderate, or low. But again, this appetite is something like, say, you are hungry. I am highly hungry too, or I am not at all hungry, or maybe somewhat. But we don't quantify that, no, that how much hunger you have. So we just want to have a kind of some level. So that level is what we call as the threshold, the level of risk exposure above which we have to address that. So, threshold is the maximum level of risk an organization is willing to accept before we can take that further action for mitigating or avoiding it. So, this is what like we are defining a point, the limit, that this is my limit beyond which I will not go. Maybe someone will have say, if we have our risk assessment that there is a 25% chances, 25% probability of delay of this particular project. So there may be few organizations who feel that no, if it is going to have a 25% probability that this project will get delayed, so we are not going to do that project. Or there would be sometimes people will say no, that 25% is my threshold. So that is what like we are trying to define that limit. Or maybe if you know that we have a risk appetite, so how much is that level? So we are specifying a level that okay, my risk threshold is I can bear a loss up to 100K. That is my threshold. So 100K is my threshold. So during our assessment, we just found that there could be a potential loss of 120K. So now we know that this 120K is too high. It is crossing our threshold level. So that means this requires some mitigation effort. We have to take some action plan to avoid or to mitigate it. That is what like we are now trying to define those thresholds. So risk threshold is basically the limit or the level beyond which we have to escalate, beyond which we have to take some action plan for those risks. So we do define these criterias, what risk will go into our risk register, what will not go. So you do have a threshold, lower threshold and upper threshold also. Anything which is going to impact $2,000 will not be considered as a risk for me. But anything which is going to have 100K dollar is the upper limit. So that is what between this 201 to this is what going into my risk register. And above that 200K dollar, that means I have to take some action plan, some mitigation plan. So this is what we understand our threshold and our appetite for the organization So based on that, we would be always going for our risk management strategies also. So now risk management plan is again our strategies that we are going to use so that we would be having our all the risk management activities that would be performed for this project. So we need to consider our project complexity, what type of a project you are working with, what type of your development approach you have. So based on that, we will be defining our risk strategies. What would be your risk strategy for your project? What would be the methodology you are going to use, isn't it? What type of a tools you would be using, and how we are going to manage them, what would be the roles and responsibilities, because we have to identify, we have to find out those people who will be responsible for managing those identified risks. Then we have to have the funding. Some risk that you are going to manage by insurance. Now, when you are looking for the third party insurance or third party outsourcing, you know that we have to have some additional funds for those premium and all those things. So, from where we have to have a provision for that also. What would be the timing? Because sometimes, no, we know that risk management is a kind of a work which is done throughout the project. It is not only in the beginning. So in many of the project we do have this risk management schedule defined in our plan also. How frequently you would be doing those risk management process? What would be your categories? What are the sources? So we do define our risk breakdown structure also. We'll discuss that. From what all sources we may have the risk so that we are not missing any of those categories. We need to record the stakeholders' risk appetite also. What is the appetite for our stakeholders? It may change also with the project. That is what we have to first understand. Then we need to have a probability and impact definitions, probability impact matrix, how we would be using. We'll just discuss about these things. Reporting formats is nothing but for your risk registers, what should be your format, and even for your risk reports when we do the audit. So we have to report our effectiveness of the risk planning. That is what the reporting formats we would be defining in the plan only. Then how you are going to track your history of the risk management part. So that is where we would be defining those document. So this is what like we have in our risk management plan. So once we have our first thing is your risk identification. So we do use several techniques for data gathering. As we have seen, brainstorming already we discussed, nominal grip technique already we discussed, SWOT analysis already we discussed, that we need to understand our strengths and weaknesses so that we can always identify the opportunities and threats which we may face. Affinity diagram, as we know, it is again once you have collected those risks, so we can just group them in the categories. Risk associated with all our technical part, risk associated with all your compliances, risk associated with your planning. That is how we would be categorizing them by making use of this affinity diagram. Then we do have this assumption analysis. Assumption analysis is nothing but you have to always check your assumptions log, because already we have defined our assumptions log. So you have to verify how many assumptions may go invalid, or whether they are still valid or they are accurate enough. If any assumptions goes wrong, it may create a risk, isn't it? We know that the approvals will be done on time, sponsors will pay the funds on time. All these are the assumptions which may sometimes goes wrong also. And then we do have a Delphi technique. What does this Delphi technique means? Anybody who has done this or experienced this? One example we did it. Yes, isn't it? Planning poker also where we have used it, because we just want to gather the experience, expert opinion, and we have to build the consensus. So it is just a kind of a more like a brainstorming, but here people are participating anonymously. Let's say, as a facilitator, I just shared a document to Anuvrat. So Anuvrat would be sharing me his uh, opinions. But maybe Hitesh or maybe Krishna is not aware. I'm sharing that document to the Krishna also, Hitesh also, but Krishna will not come to know that I have shared the same thing to the Anuvrat also, Hitesh also. So all of the participants who are participating in this data gathering technique, they are participating anonymously. So they would be sharing their opinions, sharing their the risk part, and then we would be analyzing it, and again we would be sharing them for prioritization. That is how we are using this Delphi technique. Anonymously, people are participating, so we get their views and we try to rank them. We try to have a kind of a consensus also. It is a data gathering technique where members of a group are asked or polled anonymously. That is what is a kind of a method that we use. So we select our experts, we send a first round of a questionnaire, we collect their answers. Yeah, two, three times we have to repeat it, then only we would be getting the consensus. So first we collect their responses, again we summarize those responses, we reshare them, again they would be sharing them. So that is how we are repeating it two, three times to gain that consensus. Then there is another technique, Monte Carlo simulation. This is nothing but a simulation only, but it has been named against a casino which is there in the Monaco with the name of Monte Carlo. There are so many casinos, but there is a very popular casino in the city of Monaco. So with the name of Monte Carlo, which is nothing but reflecting the element of chance. So based on that, that simulation has been named. So this is nothing but it is a kind of a computerized method we are using. It is just as good as consider you are throwing your dice 1,000 times and you are recording the readings. And then we just get to know what is the probability of getting six in this throwing of dice. So just like that in our project, we use this technique for quantitative analysis. Shilpa, same day or it depends also. May not be same day, right? That is what you may have. That depends what type of a risk you are doing it. So it could be same day, it could be next day also. But the main purpose is we want to achieve the consensus when we are going for this Delphi technique. So just consider this Monte Carlo simulation which is being used. Typically, you may have your Excels also where we go for this goal seek function. No, so we have some computer software program also. So there, what we are trying to do is the computer is going to simulate so many values and variables. With that, it will give us the most probable outcome. Just imagine that you are doing a project and we know that with this project there are some uncertainties. Maybe you are doing a your apartment construction project, so you know that there would be some kind of an uncertainties. What if our material cost vary? What if our changes in the maybe your labor cost, isn't it? So what we are trying to do is, let's say this material cost we have considered. Now we know this material cost may vary from 40K to 55K. So we just assign a probability. How much 25% chances are there that material cost may exceed 55K. There is 30% chances that material cost may raise with this. There is 10% chances with this. So we are just having so many scenarios, so many probability scenarios, and then we run this computerized solution, this computer software. So this computer software will run 10,000 simulations on the random data, and based on that data it will just tell us what is the most probable outcome to complete your project within 1 million, within your zero point 0.8 million, within your zero point 0.5 million. That is what like we are trying to get. So what is the probability? Let's say here it is coming 85% probability. So that is what we have, 60%, 40%. This is, there are so many simulations. Look, you just search for, even on the Excel also you can run. There are computer softwares, you can search for Monte Carlo simulation in Google, you will get it. So that software will run your 10,000 simulations so that we can get to know what is the most probable outcome for completing your project on a certain time, or maybe at a cost. Whether we have 50% probability we can complete this project in 8 months, we have got maybe 80% probability we can complete this project in how many months. That is what this kind of a simulation it will give you. 80% probability we would be able to complete this project in 10 months. That is what is this Monte Carlo simulation does. This is a kind of a quantitative analysis only. So what we do, we have now collected our risk. So we would be creating a risk register. So how does this risk register looks like? Maybe you people have your own risk register. So this is what like when we are preparing this risk register, you should have a proper description of those risks. If it is a kind of an IT project, we know that there could be some risk. What if key team members become unavailable? What if the data breach or system compromise, vendor delays, isn't it? Integration issues, your regulatory changes, your poorly defined changing requirements. So this is how we are recording our risk. So for our construction project, which is at a kind of a seashore, so we know that there would be a risk of floods. There would be a risk, maybe we are constructing this project during a festival season, so labor may go for unplanned leaves, extended leaves. So this is how we have. I'm just coming to that. Wait. Now probability and impact is nothing but it is again we do on a relative way. What is the probability of a risk? Whether it is unlikely, whether it is likely to happen, whether it is more likely to happen, whether it is certain to happen. So this is how we are trying to assess. Now again remember this, for your exam point of view we are just going to look into this basics only. You always do this quantitative analysis. All this is what done by the, not done by the project manager. Quantitative analysis is something which the risk management professional or the risk expert would be doing it. There are the things that we are going to understand in our project as for our PMP. This is what like as a project manager we have a risk register. Now probability is again we use the relative scale. Now we can always assume no that what is the chances, as you people said, that there would be a chances that what if our employees will take unplanned leaves. So we do have our previous records, we do have our experiences with our people. So now we can always assume whether it is likely to happen that people will take unplanned leaves, or it is very much unlikely to happen, or it is almost certain that people will take a leave. So that is how we have a scale of 1 to 3. 1 means unlikely, 2 means likely to happen, 3 means almost certain. Similarly, you may have a scale of 4 or 5. Very unlikely, likely, isn't it? Then more likely, almost certain. That is how we are using these scales. What would be the impact of those risks? So, impact again, whether it is going to have a low impact, moderate impact, high impact, very high impact. This is how we are going to assess. So again, we can have a scale of 1 to 3. We may have a scale of 1 to 5. We may have a scale of 1 to 4 also. So this is what it goes in your risk management plan. that how we are going to use our risk probability and impact scale. That is also, as we discussed, it will be a part of our risk management plan. So this is a risk breakdown structure which would be used for identifying your risk. So we know that risk could be related to technical part, management, commercial, external. That is all your legislation, exchange rates, isn't it? Your competition, regulatory. This is how we have categories of the risk which would be used for identifying those sources. Now, this is the SWOT analysis we do. We know that probability and impact definitions. So how do we define these definitions? This will go in our risk management plan. What would be the scale you are going to use? Now, when we define these definitions, every project will have its own definition. As per our shop lifestyle center, the probability impact definition, the this project manager has given maybe that any risk which is going to impact 100K is, they are considering it as very low. That may not be in your case also, isn't it? For me it would be very high. I just want to change my definition. Any risk which is going to impact $1,000 would be classified as very low. Any risk which would be having an impact of 5,000 would be low. Anything which would be having 2,000, that is what, medium. 5,000, your high. Then more than $5,000 would be something very, very high for me. So that is how you may have your own definitions. What is the very high means? Probability more than 50%, anything which is between 41 to 50. This is what, as a project manager, you would be taking the experts also, expert judgment. If you know all these things, how you can have your own definitions. Otherwise, this is how you would be always having your discussion with the risk expert to define them. Probability impact definition, why we want to define it? So that we are all on the same page when we say, because for you high definition would be something, for other people definition of high would be something, isn't it? For me, as I told you, $1,000 is a very high for me, but for someone maybe $50,000 is very high. So this is how we are trying to say, when we are assigning a risk, so we know that every risk has a probability and the impact. This impact would be on our project schedule, impact would be there on our cost also, impact would be there on the quality also. If you know that there is a kind of a risk, that what if vendors are going to delay the material, it may have an impact on your project timeline, project budget. That is what we are trying to define those things. Very high means more than 70%. If you want to change your probability, you may change that also. This is what we classify: 5, 4, 3, 2, 1. So any risk which is having less than 10% is very low. Probability between 11 to 20% would be low for me. 21 to 40% would be medium. 41 to 60% would be high for me. More than 60% is very high. So this is how we have a probability scale, and based on that we have defined our definition, that how much impact it is going to make on my timeline. Maybe any risk which is going to have a high would be impacting my project timeline 2 months, maybe 30 days. Like that, you have your own definitions. So this is how we define them. It goes in our risk management plan. And then we do have a risk probability and matrix, this matrix, probability impact matrix. How we do define? Because if you are using the scale of 1 to 5, or if you are using the scale of 1 to 3. So we know that the probability and your impact. So we have a probability 1, 2, 3. 1 means unlikely, 2 means likely, 3 means certain. Similarly, the impact low, moderate, high. So we just multiply probability and impact 1 into 1, 1 into 2, 1 into 3, 2 into 1, 2. So this is how we developed a matrix 6 and 9. Then we do have our own definitions that any risk between 1 to 2 would be low, 3 to 6 would be high for me, medium for me, and anything more than 9 would be high for me. Just like here we have our probability impact matrix. So we have on a scale of 1 to 5. So any risk, this is very low, 1 to 2. This range between 3 to 6 is low. 8 to 10 is 8 to 12 is medium. 15 to 16 is high. 20 to more than 20 is very high. If your threshold is this, that means beyond this, we have to take some action or we have to avoid. We cannot do anything beyond this threshold if this is our threshold level. So this is what like we are doing it here. Once we have our risk register, so what you would be doing it, you have to define a scale of probability and impact. If you are using a scale of 1 to 5 or 1 to 3, so based on that you would be defining a probability and a impact scale. So if we have used 1 to 5, so I have assigned a probability as a 4. This probability and impact is not also a static. It may change with the project progress also. Right now we have had a chance of particular risk may be very high, but might be as we progresses the risk may have a lower probability, or it could be vice versa. We have assessed that the employee attrition risk is very low, but might be it has increased as we have progressed further. So this is how we would be updating our risk register. What are the changes in our probability and the impact? So what we do here is assign a probability and an impact scale. So we have given a probability of all these risks on a scale of 1 to 5. So here 5 means almost certain, 4 means certain, 3 means very much likely to happen or likely to happen. That is how we are assigning this probability. Probability is the likelihood of its occurrence. That will be mostly in the percentage, whether 25% chances, 30% chances, 50% chances. That is what we have defined here. 5 means more than 70%. 4 means this much percentage. 3 means this much percentage. That is what we have our probability impact definitions. So this is how we have given a scale what is the likelihood of its occurrence, and if this is risk is going to occur, how much impact it is going to make on our project: high, moderate, low, very low. Then we calculate the severity of that risk, or we call it as a risk priority number, risk score, risk magnitude. How much severe is that risk? Just by multiplying the probability and the impact. So now, according to our definition, 20 means what? 20 is very high. 15 to 16 is high, isn't it? So 20 would be categorized as very high risk. 12 is your medium, isn't it? So based on our definition of this, 12 is medium, 9 is also medium, 3 to 6 would be low. So based on that, we understand the severity of our risk. Are you getting it? What we have done it here? First, we documented our risk. We assign a probability and an impact. We calculated severity. So based on that, we would be doing the ranking. Which risk is very high, which risk is moderate, which is low. That is what we have done is this method is called as qualitative risk analysis. So once you identify your risk, the next thing is that we have to qualify, we have to prioritize which risk will be high, moderate, or low. So that is nothing but when we say that we are doing the qualitative analysis, that means we are just assigning the probability and an impact scale for the identified risk, and we understand its severity by risk priority number or the risk score or the risk magnitude. So we do have our risk score here. So based on that, we know that we had defined our threshold for our project, isn't it? What is the risk threshold level? So we know that this is the kind of a risk where we have a threshold where we are going to say Tata bye bye. We cannot go. We have to avoid. We have to take some action plan. That is where the senior management will be taking the decision. If this risk says that we may have a chances which is going to be impacting our project more than very high means it may have an impact of more than 5 million. That means this is not our, this is beyond our threshold. Our threshold was only till 3 million. So this is where we will be not going for this project sometimes, or maybe you have to have your strategies for adjusting some adjust doing some adjustment. This is what like the senior management will be taking the decisions. That is how we are doing the risk analysis here. So once you have documented your risk, first step is we would be doing the qualitative analysis. What we have done here is the qualitative only. Do you people got this? Any doubt? Same way we have our IT project risk. So we can have the probability multiplied by the impact so that we can categorize which risk is high, which is moderate, which is low. And we can always do this prioritization. This is what risk probability would be based on some factors only, no? It will not be always the internal control based, because there would be some risk where it would be based on the external, isn't it? Just like floods, that is not in your control, but you have to have some strategies how we can mitigate, how we can minimize its impact. Probability is all where, if you're talking about how do we assign this probability, this is basically based on our prior project records. Similar project records will give you some idea what were the chances we had faced, how what was the kind of that we had faced in our previous project. But this will be again a kind of a just idea, because this project is always a unique, the circumstances are different, conditions are different in this particular project. But you can get some idea about those risks from your previous project. And this is how we do this with the experts also. You would be considering your expert judgment, you would be checking your previous project records also. That is how we are trying to assign a probability and the impact. So based on that threshold, exactly, no, how can you assess anything which you have not predicted? You cannot have, because that is what, it is not a part of our risk register also, no, Ami. We, what we can do is for our known risk, so we are just planning for our risk which we have identified, so how we could be having our strategies, what should be our response action plan, so that we can mitigate their negative impact. Because unknown unknowns, there are something which you cannot predict. If you know that something can be predicted, definitely it would be a part of your risk register, isn't it? But something which we can't predict, how could you document it? It is something which we can't even expect. That is what had happened during COVID. Nobody had expected it, isn't it? But right now, as we know, even earlier the cyclones were not so prominent in the India. But nowadays, you find that every year we have a cyclone in the southern region, isn't it? This is what we know. So that is what we know. We'll talk about that, no? The risk related to the quality. We'll talk about that. We have not covered that quality part. What if suppose your project had failed some of those quality measures? So we had incurred a issue. Though we had mitigated all our things by taking the necessary SOPs, all that thing, but still we know that we may have that problem, isn't it? That is how we are going to look for that also. Because something, this is what is a kind of our prediction only, no? Because we know that it will be having a high impact on our product brand, company's brand. So we have to always invest on our cost of conformance. We will discuss that in the quality parameter. Risk register, when we are defining, because that is what is the responsibility, the planning is the responsibility of the project manager, but this is not you are doing it all alone. This is where we are involving our stakeholders and the team. Yes, everything what you can predict, because some chances are there. So you know that when some chances are there, so there would be a kind of a risk that we have to assess. So this is again a sample example of our risk register. So we have our probability, we have our impact, we have our score, we define our trigger condition, what would be the response plan. So we'll update it in our planning. Right now, we have not discussed about our planned responses. We'll discuss, and we need to assign an owner. Owner means who is going to address that risk. So this is what who would be responsible for all those risks. So we do have a risk register. The template is how we do define in our plan what should be going into our risk register. Even the adaptive team also prepare their risk list. So they typically use their information radiators all, so that they do define, they can even add the other columns for owners, what is the status of the risk, the date of identification, date of resolve. They do have a risk list for their project also. So I think we talked about the qualitative analysis. So once you have identified your risk through various sources, this is what we discussed about those risk identification techniques. So we would be documenting them in our risk register, and then we have to do the qualitative analysis. That is what we just did it on our Excel. We assign a probability of their occurrence and the impact, and based on that, now if further required, we go for quantitative. Not every risk is going to have the quantitative analysis. So this is what, like in your exam also, because project manager is not responsible for quantitative analysis. It is always being done by the senior management or the risk management professionals. The experts are there who would be doing it. So there would be no questions based on those quantitative analysis in your PMP exam. Okay, but we will talk about those concept. What is this quantitative analysis? Just quantitative analysis is nothing but where we are assigning some numerical value. We are just trying to assess those high risk, because every risk we will not do the quantitative analysis. It is nothing but we want to understand our risk, that how much likely they are going to happen and they will be impacting on our project cost. How much dollar impact is going to have on our project, how much time impact would be going to have in on that. So this is what we do in the quantitative analysis. So there are several tools that we use in the quantitative analysis. Simulations we had already discussed, Monte Carlo simulation, where we just have our computerized methods, where we are going to run more than 1000, 10,000 simulations, 1000 scenarios, random based scenarios, so that we can come with the probable outcome using those scenarios. What is the most probable outcome for completing your project with certain timeline or at a certain budget? That is what is the simulations we use for our project. Then we have a sensitivity analysis. This is basically if you just want to focus one risk at a time, you just want to test one risk only. That if I'm changing this value, how much it is going to affect the outcome. So, mainly what we are trying to do here is we just want to identify, we just want to understand which is the most severe risk, which risk is going to have the biggest impact on our project objective. So the output of doing this sensitivity analysis is a tornado diagram. So we know that the most severe risk would be on the top. We just have a kind of a, just like a tornado also. So we know that how much impact it will have on the positive part or negative aspect. So for both opportunities and the threats, you are going to assess. So by looking at this, we can understand which particular risk is going to be the most severe, which will have the most biggest impact on our project objective. That is what we have to look for. So the sensitivity analysis is just going to help you in assessing the severity of that risk, and we can always identify by using this tool. Then we do have our decision tree analysis, EMV also, that we'll discuss. So an analysis technique to determine which individual project risk or other sources of uncertainties have the most potential impact on our project outcome. That is where we can always look for. So this is how it will be giving us in the hierarchical order. First, let's discuss this EMV. Then we'll talk about our decision tree analysis also. Now, as we know, we have our risk. This is just an example for your software risk. So we know that we have got certain risk and what is the probability. So this is nothing but probability 40%, 80%, 30%, 45% probability. Data loss, which may have an impact of this much. This may have a negative impact. This risk is having a positive impact. This risk is again a negative impact. So we multiply this probability and the impact so that we get our expected monetary value. That is what we call as a EMV. So negative impacted risk will have a negative EMV. Positive impacted risk will have a positive EMV. Then we just sum up them. So that is your contingency reserve. This is how you do. Sometimes you may expect a question in your exam also to know about this EMV. So you just have to pay attention. All right, Shilpa, you just have to pay attention. Any risk, probability, and their impact. If it is negative impact, put a negative sign. If it is positive, you have to put a positive. So sensitivity analysis, Shilpa, is nothing but what we are trying to do is we just want to know, we just want to evaluate if we are going to change one or more variables which is going to impact our project outcome. So we want to understand which variable will have the biggest impact, most significant influence on the project outcome. So that is what we have our all those risk, and then we know that which will have the highest impact on our project. This is what we are doing with your sensitivity analysis. If for example you know that there are some risk that delay in your permit, this risk will also impact our timeline. You may have your risk, what if vendor price are increased, or we may have our design errors. So we have these three risks. So now we want to plot this if we change. So vendor price hike definitely will be having the highest impact on your project cost, isn't it? That is what like you are just trying to use this tornado diagram. Longer bar shows it will have more impact. So if you consider this particular example, so we know that this is your positive side, opportunities and your threats. So if we want to maximize our positive opportunity, so you know that you have to consider your this particular variable, that is your manufacturing of reactors. This will have a bigger impact on our positive outcome. This risk have our negative impact. So this is where we have to put more focus on. So if we have to control only one risk, so we can just use this sensitivity analysis, that we can always look for the most sensitive risk for our project, so that we can have the reduced impact on our outcome. We can always control one risk. We can make use of this sensitivity analysis. Got it? We just want to compare the importance of those risks, which risk will have highest impact, which will have low impact. So we can always first focus on that. We just want to focus only on one or two risks we can consider. So by looking at this sensitivity analysis, by looking at this tornado diagram, we know that which we have to priorly first focus on. Expected monetary value is just nothing but where we multiply the probability and the impact. Tornado diagram is what like it is just going to show us the biggest impact of any risk. You just have to consider your project risk and variables. You change those variable, then we can identify which variable will have the highest impact on the project also. So we use this in the quantitative risk analysis just to identify which variable gives us the greatest impact on our cost or on our time, isn't it? That is what you would be doing it. Like say, if you want to understand for opportunity also, so you want to analyze your project cost. So in your one of the simulation, it says if our DCS fails, so can we switch for cheaper or faster alternative, isn't it? That is what we want to look for. So by understanding those results, so we want to do that. If our project cost is going to decrease, definitely it is a positive impact, isn't it? So in this analysis, if our DCS is going to fail, so it is a kind of an opportunity for our things part. So this is what you have can use for any of those risks. So you are going to use it if your DCS is going to lead towards your some better outcome in this particular model. That is what you have to see. Always look for your positive impact or the negative, whether risk is a threat or an opportunity. It is always with the direction only. You can see what is more favorable for you, what is less favorable for you. How vendor discount is a risk. Vendor discount will be a positive impact, no, Ankit? If your vendor is offering a discount, suppose, it will impact positive. It will be an opportunity. Yes, Ankit? Risk could be an opportunity, risk could be a threat. If your vendor is increasing the price, it will have a negative impact. If your vendor is giving you the discount, it will be an opportunity. So when we talk about this expected monetary value, so we are just multiplying the monetary value of the possible outcome. So probability would be in your percentage and impact would be in the dollar. Positive means opportunity. See, in the project management, just consider risk as an opportunity or the threat. We define the risk as an uncertainty. See, this is what is a kind of a term. No, in the project management, definition of risk is uncertain event. That uncertainty, if it occurs, it may have a positive impact also, it may have a negative impact also. So you just consider that in the project management we either have an opportunity or the threats. That is how the project management definition of risk. PMI considers risk as an uncertain event, because in our real time, in our literal meaning of risk is something which is a negative always we think. Risk could be an opportunity also, isn't it? Risk may give you a positive impact. You're taking some risk for positive impact also. Positive impact is an opportunity, negative impacted risk are the threats. Now, EMV, we do have another way also, that is what we call as a decision tree analysis. Now, decision tree analysis is simple to understand. Once we have got to decide, that is what yesterday we talked about, make or buy analysis, isn't it? Now, similarly, when we talk about our decision tree analysis, that we want to understand, we want to just go for our what we say, there is a risk for our project, so we have decided to first start with the prototyping. So we know that whether prototyping would be a good decision or not. We know that it would be a good decision, but just to support our decision, we want to use this decision tree diagram. So in this decision tree diagram, what we have to consider is, you know that you have got some visual representation of your decisions, how you are going to take based on the potential outcome. So we have got one or more decisions to take, whether we should go for prototyping, whether we shouldn't. So these are the decisions that we have to take. So when we are going to go for prototyping, definitely you have to have a setup cost. So let's say our setup cost for this prototype would be 200K. If you're not going for prototype, your setup cost would be how much? Zero. Now again, when we are going for this prototyping, there is not a 100% surety that prototype will pass, isn't it? So that is what now we want to assess. What if suppose our prototype fails? And chances of failure would be, let's say, 30% only. We do have a high percentage that our prototype will pass. If our prototype fails, we may suffer an impact of, let's say, 120K. Pass, there will be no impact. If you are not going for prototyping, definitely the failure chances would be more. 70% we may fail, 30% there will be no impact if it is passed. If it is going to fail, it will have a huge impact, let's say 450K on our project. Now we just find out the decision by knowing the expected monetary value. So 30% of 120K, how much it would be? 360. Yeah, 36K, sorry, plus our investment on this setup, 200K. So total comes to be 236K for this node. Pass, it is not going to have any impact, no EMV. Similarly, for this node, 70% chances of impact of 450K. What would be our EMV? 315K. Is my maths correct? 70% of 450K. And there is no setup cost, so zero. Yeah, I have added it here, no? 200K also, Rakesh. 36K is the EMV plus our 200K. That is what I have added here. So the net EMV for this yes node is coming as 236K. And here we have our, so if you calculate it, it will be zero, no? Investment is because we have already taken it in that. If it is passing, it is not going to have impact on anything. So 70% of zero is nothing, no? So that is what I have taken in the total cost. Okay, you take it 200K. It will be negative impact what we are trying to do. But again, we just want to focus here. If it is going with that, we have a 315K. So whether 315K impact or this is 236K, which is going to be less chances. See, this is what prototyping means. If you're going for, definitely it will be having a high chances of your pass, isn't it? That is why we are looking for. If you change it, definitely you change with the same scenario, you calculate it. So you will be getting your different EMV. You can do that with the different values also. I just explained you how do we do this decision tree analysis. If we say 70%, if our prototype is passed, it will not have any impact on our cost, no, because the prototype has passed. In the no case where we are not going for prototyping, definitely we are assuming that there are high chances of failure only, less chances of passing. 35% only without prototype also we can go for. That is what we are looking over here. Whether we are trying to look for our working, isn't it? So what we are trying to hear is we just want to understand our detailed analysis for going for both options. Equipment works or fails. So we want to decide, isn't it? So whether it is cheaper to go for prototyping or not. So we know that it is always cheaper if we go for prototyping in this case. In this case, don't you feel 236K is cheaper? That is what we should go for this decision. This is having a high. So here we have a high negative impact, no? So whether you would go for high negative impact or less negative impact, definitely the less negative impact. So that is why going for prototyping is a better choice. This you can do for any example. If you want to just do the decision whether you should take your insurance or not, so that is what you can analyze it. Know what is your premium you are paying, and based on that you have to see how much impact it is going to make. All that thing we can use, whether you should do it on your own or you should buy it, buy or build. So that also can be done. No, you want to decide whether we should outsource or we should do it on our own. So you know that if you want to outsource it, definitely you have to invest for that. It is 175K, let's say. If you're outsourcing a team to do that work, it will cost us 175. If we do it on our own, building it on our own, maybe our team would be able to complete in 160K or 150K. That is what is our own cost for doing that. Now we want to assess what is the probability of completing on time. If you are doing it on our own, then you have a high chances of completing on time. Maybe 75% we can complete on time, 25% there would be delay. And when we are outsourcing, might be you are assuming high chances that team would be able to complete on time, and maybe 15% not on time. Now calculate all these EMV for these nodes, you would be getting what to decide. 85% of 175K, 15% of 175K, 75% of 160K, 25% of 160K. If you do that decision, so we have to see which is going to give us a more positive impact, less negative impact. That is what is our choice of decision. Based on that we decide. This is how we can do this decision tree analysis, just by knowing our expected monetary value of all these nodes. So less negative impact, more positive impact is what we will be choosing. This is how we decide. So that is how you can go to your management, because you know that this is what is the best decision, but now you are going to support with some figures. That is what you have some ground to uh, enforce your decision what is a better choice. This is what is something we can do in many cases, whether we want to go for buying a new factory, like doing a new setup for our factory, or if we are getting a chance that you can purchase an old factory setup and you can renovate it, what would be a better choice. That is what we can make use of this decision tree analysis. So we can always assess those multiple decisions, what we have to do it. Yes, it is a break time. So before going on the break, is this decision tree clear to all of you? What we do, just understand you have your multiple chances, and we just assess based on our probability and the impact what is the net EMV, and the less negative impact and the more positive impact is what we decide using that. So let's take a break, and then we'll continue with our response strategies and the other terms also in our risk planning. So now we have just discussed about risk management plan. That is the first we do it. And after developing our risk management plan, we know that we have to identify the risk. Risk identification is not a one time job, it is ongoing activity. As soon as we identify new risk, it has to be documented, and then we do the qualitative analysis. After qualitative, it is not that every risk will be going for quantitative, and if it is a quantitative, then you as a project manager is not going to do that. It would be always done by the risk expert. The last thing is, in the planning, we have to have our response strategy. How we are going to have our response strategies for those identified risk, because we always have to have a mitigation strategies rather than going for the reactive part. So we have to be proactive. So risk response should be appropriate for the significance of the risk, because we know that our risk management strategies should be very effective also. They should be cost related, time related risk, regardless of whatever project approach you would be using. Cost effective, isn't it? If you know that the impact of a risk would be 500k, the strategies you are using to mitigate it might be asking you to invest 750k. That is what we have to consider. And this risk response should be realistic within the project context. And very important, the risk response plan should be agreed to all those relevant stakeholders. And we always have to assign a responsible person. Risk owner has to be assigned. So these are the good practices for our risk response strategies. Now, before going on to those response strategies, what we use those risk response strategies, there are some terminologies that we would be using. So we already have seen the trigger condition, and then we do have a secondary risk. Now, what does this secondary risk says? Secondary risk is basically a new risk which has arisen as a direct result of the implementing a risk response plan. This is what if you have implemented a response plan and we faced a new risk. It is just like, suppose you know that you have implemented a response plan, that because of your project work or a kind of the overburden of our team, we have outsourced a work package to the third party, so that we can mitigate, we can reduce our project schedule risk. But now by implementing this response plan, now we are facing a new risk about the vendor reliability. So that is a kind of a secondary risk. It is just as good as we have implemented the response plan to mitigate the COVID by taking vaccination. That is our action plan. But because of that vaccination, now we got a allergy. That is a new risk. That is the secondary risk. Then we have the residual risk. What does this residual risk says? Residual risk is something which is basically that risk which will still remain even after implementing response strategies, whether you have used avoidance, mitigated, still we know that we have got that risk strategy, this risk left. Just imagine you have a risk for your project, that our project may have a software project cyber attack. Just for that, we have followed all our plan, that we will be having everything planned in advance, that you will have all your processes, all your necessary checks, all that strategies. Yes, residual risk could be applied for your secondary risk also sometimes. So we know that we have our residual risk that is still left, maybe in our cyber attack. So we have identified all those things, know how you are going to do that. But we know that you cannot fully avoid that. Still, you have a chance. That is what we call as a residual risk. So for those residual risk only, we have to have our contingency also. This is how we will be dealing with those risks. Secondary risk is basically the risk that has arisen as a result of our risk response strategy. That is what is the difference between two. Just like I mentioned, for cyber attack, you have installed all your antivirus, isn't it? All your other ways you have used that you could do something in advance, but still you may have that risk. You can always plan in advance. Secondary risk also you can plan in advance, isn't it? That is what we have the two different terms as a secondary risk or as a residual risk. What is this contingency fallback plan means? Contingency fallback plan is basically where we are trying to take some action. It is just a response strategy which we are trying to develop in advance before the risk is going to occur. So it is basically we do have some action plan in place. If our primary risk response plan fails, we do have a plan B with us. It is usually a backup plan, we say. So we are already prepared with an alternative course of action if our primary plan doesn't work in that case. This is how you do prepare a fallback or a contingency plan for your project. It is just as good as you know that we have our primary risk response plan for our vendor, because we had identified a risk related to vendor, that what if vendor may delay the material. So we have gone with a very reliable vendor for our project. We have signed a very reliable vendor, but still, what if that also may fail in that case, because it is a very critical project and we know that that material is highly important for our project. So we do still have a contingency plan, that we do have some more vendors list with us. We have mitigated that risk by choosing the most reliable vendor, but still we may have a contingency plan that in case of any issue, we have our fallback plan or plan B, that we may have our surplus of inventory, so that we can always address that risk also. We can have a buffer stock for our those parts ready with us. Or maybe we do have some kind of new other vendors list with us who would be able to supply that material in case it is required. That is what we call as a fallback or a plan B in case our primary response plan fails. Contingency reserve, as we know, it is the money that we have allocated in our cost baseline for response strategies. That is how we would be using those reserve for our known risk. Please do keep it in mind, the money which we have used, which we have allocated in our cost baseline for the known risk with their active response strategies. So contingency reserve would be only used for that. So this is what like we have our, this is an exam tip, the difference between secondary risk and the residual risk, how you would be addressing that. So we do have our contingency defined in such a way, because we have to have our strategies first, how we could be responding to those risks. So there are several response strategies we'll talk about now, for our threats also, for our opportunities also. How do we handle those risks for our project? So one by one we'll talk about. First is, let's discuss about our threats. So we know, if any risk which is not a part of our risk register, we have faced a kind of an uncertainty that was not there in our risk register, or something has impacted our project, where as a project manager you cannot take the decision, it is beyond your authority. That is where you have to escalate. Escalate means you would be always seeking the advice from your senior management, because for management reserve also you have to escalate. You cannot take the decision. Then we do have second strategy as an avoidance. So mostly if you are having a high severity risk which is going to have a high impact, this is how the first action of ours should be to avoid it, to eliminate that risk. That is how we could always be looking for. But always it is not possible for us to avoid the risk. Though it would be our first priority, that can we do something to eliminate it or to avoid that? This is what is the risk avoidance. Just like we got an example that we have a kind of a risk for our building project, that might be we are trying to construct that building project from our June month or July month. So we know that the seashore, where the location where we have our building, that is a highly prone to the cyclones. We know that that cyclone probability is very high, impact would be also very high. So that is going to be very high risk for us. So can we do something for avoiding that risk, avoiding that impact, or for thing? So might be one option could be you could change the location. That is how we have avoided it. Or second thing could be how you can avoid that thing. Maybe you have to adjust your plan now. Instead of now, we have to shift our construction activities once that period is over, during the non-cyclone period itself. That is what is the avoidance. We have to just eliminate that risk. If you know that there are some material which you may face some kind of a shortage, or which may be having a kind of a some delayed supply, so can we have some other material which we can replace for using that in our project? That is what is a kind of an avoidance. If you can't avoid that risk, because everything cannot be avoided, we know that we cannot avoid that risk, can we do something to transfer? Transfer means we are just making the another party, third party responsible for that impact. That is how we are taking those insurance, isn't it? This is how you are trying to outsource your third party. You are just transferring that risk to them. That is the transference. We know that we have a high chances that our team will not be able to complete this particular deliverable on time because of their other engagement. That risk is high. So what we can do, can we outsource it? Or our team may not have a required expertise to deliver it. So maybe we will not be able to complete it with that quality. So we have hired a third party, isn't it? That is what is a risk transference. Then we have mitigation. If you can't avoid, if you can't transfer, can we do something to minimize its impact, or at least its probability? That is what is the mitigation. We know that we don't have an expertise to do that, or maybe if we cannot transfer that risk to the third party because our budget is not allowing us, so how we can mitigate it? That is how you can provide those trainings. We can do some kind of our mitigation strategies. You can do some additional testing so that we can try to reduce those defects. This is how we are trying to mitigate or minimize the impact of those risks. Lastly, for the low risk, low impacted risk, or for the risk which you cannot do anything, we know that earthquakes are there, but still no, you cannot do anything for that. That is what sometimes we just accept them. So when you are accepting it, so definitely you have to have your contingency also for your active acceptance. That is what is, we would be doing nothing. Acceptance means we just do nothing because impact is very low, or impact is that high that no response will have any influence on that risk. So this is what, like if we are knowing that you or your site is near to that volcano, maybe that cities. So we cannot do anything for that, isn't it? That is what we just accept, and based on that we would be taking those action. This is how we have our response strategies. Even the risk which are related to your legal matter or your regulatories, project manager cannot take the decision. Those risks also has to be escalated. Let's take our same example of our risk register, that we have our these risk. So how we can have our response strategies. So this is what regulatory risk could be escalated. Storms and hurricanes can be avoided, where we can have our adjustment. All those theft, fire could be transferred to the third party, where we can have in our contract all those penalties, guarantees, warranties that we can use, isn't it? So this is how we can try to mitigate the impact of this coastal erosion due to that flood. So we can change some strategy, we can have a kind of a working, some procedures, some plans in a way so that we can mitigate their impact. That is how we are. For labor shortage also, we can have a kind of a mitigation plan. We can have some of the other contractors list with us who would be providing us on time. Power outage, we can just accept it because we know that we do have our backup for that. We do have a backup server, so it is not going to have any impact or much impact, because within the 2 hours or within the 3 hours or maybe within a one day we would be able to replace that server. That is how we accept it. So that one day would be our contingency reserve, that we will keep it in our project. This is how we have our response strategies. Any of the response strategy for threats, if it is not clear, then we'll move to our opportunities. When to escalate, when to avoid, when to transfer. So most of the time, if it is a high impacted risk, our first action plan should be to avoid it. If you can't avoid, can we do something to transfer it? If you can't even transfer, can we do something to mitigate? And even the risk which are having a moderate or a medium impact, we should try to mitigate their impact. That is what you cannot do anything. No, it would be acceptance only, because certain risk you can't do anything. That is what we have to have our acceptance for those risks. For that is, isn't it? This is what you know. Now, what would be the impact, or maybe for that you can define your secondary response plan for that. What action plan? That is what we have when we say acceptance, or we. So this is how you would be doing that. For avoidance, we are basically either changing our plan, or we are just trying to eliminate that risk, isn't it? This is what we are saying. So when we say there would be a kind of a risk that you are trying to do some server upgrade. So we know that our server upgrade may fail during our go live, or maybe it may have some kind of an impact on that. So that is what we do. This is how we are trying to do that work during a very low traffic weekend. That is why we always negotiate with that window, no, where it will have that kind of a thing. So this is what, like, we are trying to do that avoidance, no. So sometimes you know that by avoiding, it may create secondary risk also, isn't it? So that is how those risks would be also documented, and we are going to have a plan for them as well. So avoidance, even mitigation will create a secondary risk. No, we are taking some action plan to mitigate it, but it may create a secondary risk also. Even by transference, also you may have a secondary risk. No, you have outsourced the third party, but still we have a new risk because of that. But when you are accepting it, definitely this is what we are trying to work on our response strategy for that. Yes, Ahitesh, because that is how we are trying to deal, no, because it is basically a very high risk. So this is how we are trying to avoid, because our threshold is there. So this is what, like, even increasing the timeline will be okay. because that is what is the level of risk we have. We cannot do, no, that is how we have to avoid by changing our timeline of construction activity. So we may have an impact of 6 months or 4 months after that. So for that you have to take the approval. This is how we are going to discuss with our senior management. Because of that impact we cannot do anything. Avoidance will always be a better cost effective solution, isn't it? That is what we have to look into. This is how our strategy should be, because this is what you will be going for. Because the same thing, no, I think Joshua's asked, what about earthquakes? You cannot do anything, no? That is an external, natural risk, non controllable threat, isn't it? But you may have some kind of a planning for its impact, isn't it? Some kind of an impact you can try to plan, because that is what we do. If it is a kind of a project you are doing it, so the building has to be seismic resistance, isn't it? Or maybe you can have a transference, something, your equipment, your other things can be always taken for that insurance part, isn't it? And that is what you would be doing it. If you are going to accept it, so you know that what would be the impact, because all those residuals part is what you have to deal with. That is what you would be using it. You know that if it is a kind of your office, you have your data with you, so you should have a kind of a data backup on the cloud. Maybe you can look for some uh, virtual team working, isn't it? Maybe you can look for some alternative. This is how you have to look for your response strategies, considering those risks, how much impact it is going to make on the project. This is what, when we talk about our agile project, so we know that we do have our mitigation strategies defined for our agile project also. So we have to have those mitigation strategies. And after that, the acceptance is what, like, it is done with the real time working. So in the adaptive project we always try to focus same there also proactively. That is how we are working on the small iterations. So if you know that we do have a kind of a activity or a kind of a sprint we call as a spike. Spike is something where team is investing their time just to have more details about those project user stories. So this is how we always have in the adaptive project also. We continuously identify our risk with every iterations. This is how we are going for our all these lightweight methods. Iteration wise, we do it, isn't it? We are always having our risk response planning also done when we plan during our iteration planning. So we do have our planning for those proactive action plan for the risk also. And this is how we will be implementing it. But if something has happened in the real time, that is how team do discuss together and they will be coming up with their solutions. This is how we say no, we are inspecting and adapting daily stand ups, retrospective reviews. That is how people are responding towards that. We work on a very small time box, 2 weeks, 4 weeks. So we are trying to reduce our failure also, because we want to, that is what we have seen, no, fail fast. We'll discuss about that also. Fail fast is all, but whatever is the more unclear user stories or complex user stories, we always try to first do them in the beginning, so that if we fail in the beginning it is good, rather than failing at the last sprint. That is what we always look for our project complexity. So we always look for doing those piece of work which is highly riskier, so that we can learn from our mistakes and we can try to have our new strategies for that. So same strategies you would be using for your agile as well. Same. Now opportunities, again, we, if you see, escalation and acceptance are there for opportunities also. Just like we talked about, there are some opportunities for which you cannot take the decision. You know that there is an opportunity that if you have to buy your Jira licenses for your software, or maybe Microsoft project, or maybe laptop for your team, so that vendor is offering you 20% or 10% discount on some bulk purchase. But for your project, as a project manager, you know that you just need 5 licenses or maybe 5 laptops, but you know that other project of our organization is also going to require them. So that is where you have to escalate to your program manager or to your senior. You cannot take that decision. Something which is beyond your decision making authority has to be escalated. Exploitance means just a reverse of avoidance. All the high risk, high impacted, high scoring opportunities you have to exploit. Make sure they should happen in our project. We need to make sure that they should always happen. We know that by using the softwares like your Jira or Microsoft project, we can always ensure that we would be able to complete our project on time. So we have to exploit that opportunity. Make sure the team use this Microsoft project. We know that following those SOPs, we can definitely follow, we can definitely reach our those quality parameter. That is what we have to make sure. So 100% you are going to make sure that those opportunities should occur. That is the exploitance. Just like here we avoided that risk, we eliminated it. Here we want to make sure whatever you can do. If you want to change your plan also, so to exploit that opportunity, you should do that. You know that by using a particular resource on your project activities, it would be saving your 1 week of time. Or we know that if we complete our project 1 week prior, we have an incentive. So we have to change our plan. Maybe you have to find the best of the resources should be applied on the critical path to exploit that opportunity. Then comes the sharing. If you know that there is an opportunity but it is not a high chances that we would be able to exploit it, so can we do something to share it with the third party? Bring in third party. We are working on a project and we have got an opportunity by our client. Maybe it is a website project and that client is offering you another project to develop a website for his another branch or another brand. You know that you don't have a resource or a team. Might be can we share this to the third party? So again you have to share the profit also, but this is how you are trying to make some profit also. Then we have the enhancement. Again you know that you cannot exploit, we cannot share. So there is a kind of an opportunity which is not a very sure or very high scoring, but can we do something to increase its probability? That is what here we reduce the probability. Here we want to enhance, we want to increase, we want to maximize its impact, we want to increase its probability so that we may able to have that opportunity with our project. Acceptance is again do nothing. All those kinds of an opportunity which are impact is very low. So maybe it is just like it happens, it falls in your lap. This is what is a kind of your response strategies for your opportunities also. Just like for our hotel project, this project, we do have some opportunities that for that building, hotel building project, if we implement some sustainable, eco-friendly design elements, so we may have those environmental conscious travelers, we can attract them. And we know that location, we do have maximum travelers with that mindset. So there we can do exploit that opportunity by using all those environmental friendly materials, installing the solar panels, rainwater harvesting. That is how we are trying to go for that strategy. Maybe we want to have a kind of an opportunity that we may attract some exclusive guest also, so that by offering some high end amenities like spas, fine dining, all those things, that is what we can always try to enhance it by investing in our those facilities also. That is what is a third opportunity, that if we have a kind of a collaboration with those local vendors who are offering those exclusive packages, tour packages, isn't it? For that, we can have a kind of a benefit, and this is what we can share with those third parties also. So, this is how we make use of these strategies for addressing the opportunities as well. Any strategy if you want to discuss which is not clear? Acceptance means doing nothing because impact is low, or we cannot do anything for that. Exploit means avoiding, means either eliminating it. If you know that there is a work package which is going to be highly riskier, very huge impact, can we do something to eliminate that work package? We can have some other adjustment for doing that work. That is what is the avoidance. Or you can do some adjustment. Just like we know that we are working on a project of our annual conference, our organization's annual conference. So we have a kind of a brochure printing. We know that this brochure printing, you have selected a particular GSM quality paper. So now that GSM quality paper, the vendor is saying this quality paper is always have a kind of a high demand in market, and it may have a kind of an impact that you may face a 1 week of delay to get that quality paper. Now you know that your annual conference date cannot be changed, and it is a high risk for you. So you just gone with other quality instead of that particular quality paper because this is what you want to avoid it. No, it is not that first point of risk response to be escalated. Do no. This is basically escalation will only happen once it is beyond your decision authority. It is that as a project manager, you cannot decide if something is impacted based on some legal matter. Some regulatory compliances are there which has impacted your project. Now, you cannot take their decisions on them. There is a kind of a dispute between a vendor, which is a kind of legal aspect. It is just a kind of a breach of contract. You cannot do anything. That is where you have to escalate, isn't it? Always, if it is a high risk, high scoring risk, our first choice of action should be avoid. But we cannot avoid all the risk. It is not possible to avoid every risk. No, that is what we had seen during COVID. That first thing, what we could avoid going on the roads. So be stay at your home. That is what is the best option. But we know that everybody could not avoid that risk. That is what we know that the frontline workers, doctors, all those people, they mitigated it. They mitigated that impact, no, by PPE kits, all this mask, all those sanitizers. That is what they mitigated it. Certain risk could be transferred. That is what we take our life insurance, medical insurance. This is how we are trying to mitigate its impact by transferring it to the third party. That is what we have to see. So Joshua, got it now? Why do we exploit? Is nothing but here we want to make sure that risk should happen. It is just like, say, we have got a opportunity that if you complete your project 2 weeks in advance, there is a 500K incentive. So you just go to your team, hey, we have this opportunity. So now you are just taking all the actions by fast tracking, crashing, applying all the best resource on your critical path so that we are going to exploit. We are going to make sure that we complete our project 2 weeks ahead. That is the exploitance. 100% that opportunity should happen. That is what is just the reverse of avoid. Here we eliminate, here we want to make sure 100% it should happen. Hey, it is not the first step actually, it is just like they have defined the different strategies. This is not that we have to follow in the same sequence. Escalation is only the used. Yes, avoidance means eliminating or adjusting your plan. It is just like to compare, actually, they have used this sequence. Hey, yes, this is what for opportunities only. All these strategies for opportunities. When we are saying exploiting, that means we are working for opportunity. Sharing is also opportunity sharing, enhancement of opportunities. And when we say avoidance, means we are trying to avoid the threat. We are trying to transfer the threat to the third party. We are trying to mitigate, minimize the threat only. So these strategies name you should remember. No, escalation is not, this is a kind of a strategy response plan, because as a project manager, as I just mentioned, you doesn't have got a full authority on your project. Yeah, something which is not in your control, you know that we have an opportunity that we can save our time by using this technology. So our team has got benefited with the technology. So now we know that this technology could be benefiting other teams as well. You cannot go to that team and go to that particular person that, okay, you follow this technology, it had worked well for us. What we could do, you would be escalating it, isn't it, to your seniors, then they would be sharing that best practices to the other teams also. We know that we have a chance of an opportunity to save our money by doing this bulk purchase of an equipment, but for your project you cannot take that decision. That is what you would be escalating it. So with something which is not in your authority, that has to be escalated, whether it is an opportunity, whether it is a threat. Now, the difference between escalation and enhancing is that, sorry, the exploiting and enhancing is that exploiting means there are high chances of that opportunity, so we should exploit it. But if you know that it is not a kind of a high chances, just consider you are going to a national park, Tiger National Park. Whether you have a 100% surety that you would sight a tiger, is it sure that we can exploit that opportunity? No, it is not 100% assurance. Can we do something to enhance that opportunity? Maybe you would be taking a ride early in the morning when we know that there are high chances of sighting a tiger. You would be taking a kind of a safari, isn't it? That is what is the, you will be taking a guide so that he knows what are the possible locations for sighting a tiger. That is what we are taking those action plan, so that we are increasing our probability for those opportunities. We are trying to increase its impact or probability for those opportunities. Yes, Prakash, is it clear now? Enhancement means it is just trying to increase, and mitigation is for the threats, how we can reduce the probability or its impact. Do this question. Time up. I am ending the poll. So this is the result. So there is a almost tie between contingency reserve and the management reserve. Let's discuss. During the development phase of a construction project, key stakeholders approved a project budget. Team identified risk and appropriate risk responses. However, during execution, unexpected local health emergency halted and delayed the project work on the project. This event type was not identified as a risk listed in our risk register. The team decides that this issue must be mitigated, which would incur additional cost. So we know that we have got a kind of an uncertainty which was not a part of our risk register, and we have handled this issue by mitigation, which will require some additional cost. How should project manager address this unforeseen budgetary overrun? We know that any unknown has to be addressed by how? Management reserve. Always keep it in mind, because contingency reserve is what we have kept for our known risk. How we are going to mitigate, how we are going to address those identified risks, that is what we have kept for our contingency reserve. For any risk which was not a part of our risk register, no, contingency reserve is only for our identified risk. That is what I mentioned. Contingency reserve we will only use for known unknowns. That is what I mentioned. There would be at least a question on this understanding. That is what you would be escalating, no? You have to escalate it. You would be like addressing that additional cost by using your management reserve. That is what you'll go to your management, no? Hey, sponsor, this is something which has happened. So, now we have to go for using our management reserve. Management reserve is always at the discretion of the management. Even you will not know how much budget they have kept it. That they decide based on the complexity of the project. That is what they will not disclose it always to the project manager. You will not have what budget they have. But this is what you would be going to your senior management. This is another question. One tip I will give you, please do not answer quickly, because there is no special marking if you answer in a less time. They will not give you any additional time. So you should spend a good time, maybe at least 45-50 seconds for each question, so that we have got good understanding. Time is up. I am ending the poll. These are the result. Maximum people have opted for A. Let's discuss. If you remember when I showed you the slide for good practices, if you remember that slide, when I just mentioned what are the good practices for response plan. Remember, these were the best practices as per the PMBOK. The response strategy has to be appropriate, cost effective, realistic, agreed to by all the relevant stakeholders, owned by a responsible person. So now if you read it, what would be your best option? Isn't it? Now everybody changed it, no? So that is what, okay, just revise these slides, all these best practices as per the PMI. It will help you in the exams also. This is one of the exam like question only. Last question, then we'll wind up. What are the agenda of stand-up meeting for a sprint? Based on that, please answer. Do consider the ceremonies, what we do, what are the purpose of doing those ceremonies. Based on that, please answer. So we are done with our timing. Already time is up. So this is the score. 56% people have opted for C, 25B, 17D. So this talks about the stand-up meeting is where we are trying to micro commit to uncover problems. Now stand-up meeting is not basically how much we have done for releases. No, we don't have this stand-up meeting for release, isn't it? Stand-up meeting is there for each sprint. So you can simply eliminate these options which talks about your release. Now we have left with option C and D. Even stand-up meeting is for, isn't it? Stand-up meeting is all we are trying to discuss our problems, issues, isn't it? Not discuss means noting it down. We will not discuss about what I have done before, like last sprint until next sprint. Stand-up meeting is a daily meeting, no? Based on that, you have to answer it. Previous question, this one you were talking about. Somebody asked me to show the previous question. Nisha, is this the question you were talking about? Yeah, Munmun, that is what but we discuss about our issues, impediments, problems, what are there. So we just make a note, no, on that. We don't discuss it, but we bring up those problems. That is what everybody is doing these discussions on daily basis. We are going to complete our project within the time, within the 2 weeks of sprint. So stand up is a platform where we can showcase, where we can come up with all the blockers, all the impediments we have. So this is what, like, we are done with our today's agenda, and our agenda was Krishna. This question only you were talking about, which is I have shared it on the screen. So this question talks about we have a response strategies, but that's response strategy. We know that half of the stakeholders are happy with that response, other halves are not, and they are refusing to sign it off. So we know that whenever you are planning for response strategy, it has to be always agreed upon by all the stakeholders. It has to be cost effective. It has to be relevant to that risk, isn't it? So we are trying to have a response strategies for your new brand material, for new material, which is not fully tested in a building project, isn't it? So that is what now what is the option which is going to be best for considering it? Suggest a different owner as an executive. Again, it will not be a good option. No, you have to take a consensus. So C is not a good option. Suggest they proceed with the proposed risk response. Again, it is not a good, because people have not agreed and you are just bypassing them to follow certain things. Suggest a quantitative approach to give more accurate financial impact. Again, first of all, if you compare A and D, a and D, definitely this would be better options. Then you could do the further analysis, because right now people are not satisfied with the response strategy. This is what we have to go for, our appropriate risk response strategies. Comparing it, this is the best solution in this scenario? What answer you have marked, Krishna? A only or other one? What according to you? No. If you compare A and D, D is always a better option. Quantitative approach is just going to tell you the monetary aspect, the dollar impact, that okay, how much it is going to have. But maybe if you find out some other response, that may be more effective for that, no, rather than just focusing on one response strategy. That is what D is the better choice. Yes. So with that, we have finished our risk topic. And next, we just have left with very few topics, which is just a half an hour, not more than that, also to cover our risk, sorry, quality. Quality is where we just have to have our one plan, quality management plan. How do we have our quality matrix, quality plan, quality standards? That is what we'll be taking. And finally, integration. Every task you will have at least 5 to 6 questions. There are 35 tasks. You will expect from each task there would be a question in your PMP exam. You cannot leave any of that task. Each task is important. So then we would be left with very small topics about our fourth chapter and the last chapter. Just a minute, I have to see the drive link. If somebody has drive link, can you people help me? You haven't got your digital kit yet. Why, Vijendra? So before we wind up, thank you team for the people who don't have any questions. They may log off, and the people who still have some questions to discuss related to operations part, please do stay back. So Vijay, okay, I thank you Nikhil. He has already shared the drive link. So Vijendra, what is your problem? Have you attended your first session or not? Yeah, Brijendra. And do you get your digital kit with you or digital key? You received your digital key? Not yet. I'm just giving you the unmute access so that we can listen to you. What is the problem? Yeah, please go ahead, Brijendra.
Ma'am, I attended all the session, but still I'm not getting my digital kit.
Have you checked your LMS portal?
Yeah, already checked. As per your last
Huh.
session, you suggesting to other students, but still I'm not having any volunteers
No, no, no. Have
helping
you
me.
claimed that digital key from the LMS portal or not? Go
No,
to your LMS. Go to your LMS portal. It must be there, no? Just go to your LMS portal. Under your
okay,
profile section, you can see claim digital key.
I'll check it again because I haven't received it.
Hemashri, I have today only I have uploaded the yesterday's sessions note, that was the schedule plan, and today for this risk and budget also I have uploaded it. Just look at it now, Hemashri. Today only I did it.
No, there is no digital kit yet, ma'am.
There is no digital kit. Brijendra, have you raised a support ticket for that?
Yeah, already raised 2 3 times, but there is no response or
Wait,
no
wait.
answer.
I think we have a LSM. He would be supporting you on that. So yes, Lindsay, what we can do, your assignment for today is just revise your. Uh, we covered our budget planning. We completed our procurement, and we completed the risk. So these three tasks you have to revise, and you can do the questions also from the drive if it is possible, if you get time. And tomorrow we will be, sorry, not tomorrow, because right now next week we will complete our this chapter and we'll start with our fourth also. Yes, yes, yes. I will just share it. Wait. Nisha, if you're talking about the LMS, The questions part, LMS, I'll upload it today. On the drive, there are questions. Krishna, for the PMP application, we will be talking about on the last day. PMP questions, there are, if you see, if you have completed your schedule, there are questions on the schedule plan. There are questions on the your ground rules also. If you have done them, please do them. The topics that we have covered, try to do that. You are talking about, I think, the, yeah, Google form, that so that you can raise your questions, Rakesh, right? So what are your questions right now? If you have it on your word or in anywhere else, you can just share me on the personal, ping me. I'll do that, because I think I have not yet created that form. Might be it is my bad. It got slipped. Let me just create a Google form for that. If you have those questions, you can just share me personally. I'll just look into that. Yes, Lindsay, I am just creating a Google form. Next week, I'll share it to you. And for the preparation part, how you have to focus, as I told you, first point of reference should be your exam content outline, that PDF you have from the PMI digital kit, all the 6 chapters PDF. You have to do that, and then you should do lot of questions. So questions is what it would be giving you the confidence. Okay, that is what you have to always look for. I'm just sharing that because only the question you have to share. I'll create it and I'll upload it on the answer. Just a minute, I'm just giving you the link. So I've just shared the link. You can use this link to share your questions. I'll upload it on the drive itself with the answers. Krishna, if you are not able to attend the last 2 sessions, you have to go through the class recordings only. Please go through the class recordings. That is how you can help. You can always do that, because 80% attendance is mandatory. So anyway, out of 10 sessions, if you have attended 8, it would help you for your attendance marking. Yes, Hemashri, wait. You have some queries. Please go ahead. What you have to speak? Yes, Hemashri, I have given you the unmute access. Unmute your mic.
Yeah. Hi, ma'am. Thank you for unmuting me. I don't see any past classes, ma'am, on an LMS. So I missed on 25th. I wanted to like kind of go through the recording.
Okay, class links are not there.
No, no classes, like any of the classes that I've
Uh,
attended.
is it so? Because I think classes recordings are already there. I can see uh, under your live classes, you could see.
Live classes, only this one shows. Under live classes, my class, this session, whatever that is. If you want, I can share my screen, ma'am.
What about other people? Are you facing the same thing? Okay. Maybe let me just see. I'll give you the screen sharing access.
Okay.
Yeah, you can do that now.
I hope you can see my screen, ma'am. So under my classes, and if I go to past class, there are no classes to show.
No, not past. You show under my class only.
Okay.
Just come down. See, all the classes are there, no?
Oh, here. Okay.
Right?
Okay,
Because
ma'am.
past
Okay.
classes means once your
Huh.
course is completed there.
Okay.
All the
Okay, ma'am.
classes are there, right?
So what I have missed, this if I play, it should give me
Ah,
the
you can,
result.
yeah. And this
Okay.
link, this pin icon
Mm.
says some session materials are there, right?
Documents that you've attached, and this would be the recording, no, ma'am?
Exactly.
Okay. Thank you, ma'am. Thank you so much.
So the people who are not able to download from LMS, because that is what people are saying, you have to unblock your pop-up actually. You have to manage your pop-ups to download. And sometimes downloading all will help you. So let me just attach those documents here, the lessons notes. If you want me, wait. I have done that. So for all the task for our planning, I have done it here. So please download it from the chat window before we close this session. Especially for the people who are unable to download it. Because though from Drive you can download everything, still if you are not able to access the Drive, you can make use of this chat window. And the questions part, let me just do that. Schedule management questions, procurement questions. So Jyoti, if you are there right now, what we have for your preparation part, as I think I just guided you, that please refer to the PMI digital kit first and then try to do the questions. That is what should be the best way to help you. So, all right, team, thank you very much. See you next week. So, do revise the topics that we have covered today.
Thank you, ma'am, for an insightful session, and a big thank you to everyone for your active participation. Before you leave, a feedback survey will appear in your browser. We truly value your input. If you have enjoyed this session, we would appreciate a 5-star rating. If there is anything that could have been better, please share your thoughts with us. Your feedback helps us to enhance future sessions and create a better learning experience for you. Once again, thank you and happy learning.